I request the ICAI motto song to be played now. I request everybody to stand up.
य एष सुप्तेषु जाग्रति य एष सुप्तेषु जाग्रति कामं 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 कामपुरुषो पुरुषो निर्मिमाणः निर्मिमाणः तदेव शुक्रं तद्ब्रह्मा तद्ब्रह्मा तदेवामृतमुच्यते तस्मिन् लोकः शतः सर्वे तदूनात्यति कश्चन एतद्वैता 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 एतद्वैता.
Before I introduce the speaker, I request Dr. C.A. PHALGUNA Kumar to please come on the dais. Friends, Dr. C.A. PHALGUNA Kumar, though he is 71 years, he doesn't look like that. He is quite agile. He is a practicing CA at Tirupati since 1979. That is nearly 47 years now. And I think within 3 years, he'll be celebrating his golden jubilee in practice. He is the managing partner of E. PHALGUNA Kumar & Co. He is married to Srimati Vijay Lakshmi, who is a doctorate in home science, and she worked as principal of TTD College. They are blessed with a son and daughter. Both of them are qualified CAs, practicing with father, and daughter-in-law is also a CA, practicing in the same firm. So it's basically a family of CA members and a good homemaker to take charge of all the 4 CAs. His educational qualifications are MA, MCom, MSc in Psychology, MBA, BL, DISA, PhD. He is also a member of the Institute of Company Secretaries of India, a qualified independent director of IICA of MCA of Government of India. He was appointed as a member of Board of Studies of SV University and also of SP Mahila University for the period 2012 to 14. He presented more than 500 technical papers in income tax in the past in various CPE seminars held all over southern India. On GST alone, he has delivered more than 50 lectures across SIRC branches, chapters everywhere. Most of his video lectures are also viewed by many on YouTube. He got his doctorate, that is PhD, in accounting and auditing standards for non-profit organizations from Sri Venkateshwara University at Tirupati. He has served as a special auditor for TTD, Tirumala Tirupati Devasthanam, for 30 years from 1985 to 2015, which is a rare achievement. He is serving as the Society of Trustee and executive member of several charitable institutions at Tirupati. He was appointed as a finance committee member for 3 years from 2020 to 2023 of IIIT in Allahabad in UP. He was a member of the SIRC of ICAI from 2010 to 2019. He was chairman of Southern India Regional Council for the year 2016-17, which was a very landmark year. He was appointed by CBDT as a member of AP State Regional Direct Taxes Advisory Committee for 23-24 and 24-25. He is also a co-opted member of the Direct Tax Committee of ICAI for 26-27. Friends, The list will go on, but I just tell one practical experience. I met him in 2010 when he had just come into the SIRC council as an elected member. When I visited Tirupati for a scrutiny case of mine, I just called him up and he told, please come to the office. I went and visited his office. I found him to be a very humble, down-to-earth and knowledgeable person. Please welcome Dr. C.A. PHALGUNA Kumar. I request senior member of our profession, C.A. Natarajan, to kindly come forward and present a memento to Dr. C.A. PHALGUNA Kumar. The floor is all yours, Doctor C.A.
Oh Namo Venkatesa. Dear friends, as new Income Tax Act, that is 2025 Income Tax Act, has come into implementation from 1/4/26, as we all know. But it is also a fact for the assessment years 26-27, for the assessment years up to 26-27, the provisions of the old act only will apply. For 26-27, we are going to do the tax audit in July, August, file it by September. So the scrutiny may take place. The scrutiny may take place by selecting the 26-27. I want this 1.5 hours now, 10:30 up to 12 o'clock continuously I will speak. But it is not a mere in the AC room sitting and listening. I want every one of you, every sentence, every word in the sentence to hear attentively, so that minimum 20 questions I am going to put to you. If you file this 26-27 return of income, because the assessment and my topic is strategy in assessment. In fact, in one nutshell, what should be your strategy in assessment? You file the tax audit report, don't worry. After that, when it is taken up for scrutiny, how attentive one should be, how careful one should be to meet the ends of the justice. Ultimately, or stretching the imagination, though we pass the CA inter section 1 to 80 of the Income Tax Act, we pass the CA final section 1 to 298 of the Income Tax Act. In reality, is every income shall be computed only as per those sections, especially business income section 28 to 44. Is it that only that within the four corners of the 28 to 44 the income has to be finally computed, assessed? No is the answer. The judge made law above the Income Tax Act, real income shall be assessed. One cardinal principle. What is meant by real income? Income means really what is there in his hands as surplus. Number of decisions. So in India, we are governed by the Constitution, Indian Constitution. The Indian Constitution, Article 265 says, no tax shall be collected either by the central government or state government without the proper authority. 1 rupee more, 1 rupee less, you should not collect. The government should collect the correct tax. Section 265, Article 265. And also Article 14. Article 14, your fundamental right that equity should be there. Because of Article 14, number of income tax decisions. What the Article 14 says? Justice, equity. The assessing officer gave a show cause notice to be replied within 3 days. Assessment is invalid because of Article 14 of the Constitution. So, number of decisions were set aside. If the officer without jurisdiction has given a notice, the officer has given the notice beyond the act given time, then Constitution Article 226, file a writ. Writ says the notice is invalid. You have seen hundreds and thousands of such assessments were kept aside in 2023-24. Java versus FAO. Jurisdictional assessing officer issuing a notice of 148A, where the act said in the faceless assessment, the notice should have been given by a faceless assessing officer, not the JAVA, read with section 151 of the Income Tax Act. Hundreds and thousands. Thereby the 2026 they have to amend with retrospective from 21. Any officer is an officer with retrospective. That is also Supreme Court said in April 2026. You amended, but the amendment will apply or not, let the High Court say before 30th September 2026. Another example. 2016 November, December, the demonetization period. Central government CPE issued an SOP. Whoever deposited SBNs in their bank account, somehow or other you make that. That's all bogus. How can a depositor specified prohibited bank notes in their bank account make that? Thousands and thousands of assessments. Sir, I am a jewelry merchant, I am ordinary merchant, I am a fertilizer, my sales are all to farmers. Agriculture is saved for 6 months, 8 months the old notes. Suddenly you announce, they will come. Except that money, that farmer is not having any other money. I have to accept and sell my fertilizers. No, I don't believe. Your black money only made us sales. Where is? I am bound to maintain as per central government the stock register for all the fertilizers. Every day to which farmer I have sold, I should enter. The central government gives subsidy for fertilizer purchase. Where is the manipulation? I don't believe. The officer says, my 68, 69, 69 ABCD. To the satisfaction of the officer, you should give a reply. You are not given to my satisfaction. What satisfaction? The assessor can do it. Add. Okay, add it. Hundreds and thousands of appeals. 1718 assessment here. Hundreds and thousands of. And added to this demonetization in November 10th, 2016. December 16 of 2016. 115 BBA, because they are all going to make additions under 68. Oh, there is all additions on 68. Why 30%? In the middle of that, they enhanced it 115 BBA to 60%. Number of high courts from 2003 onwards, the assembly said, increasing the rate in the middle of the year is invalid. Any rate which is applicable as on 1/4, that is only the rate. Number of high courts. So ultimately, all these thousands and thousands of assessments would resulted into lakhs of crores of income tax, all vanished. Judges decided, not the income tax officer decided. So, as practicing chartered accountants, though we are 100% having the authority on the Income Tax Act, that alone is not sufficient for practice. That is only 50%. You should have the remaining 50%. The judge-made law, how to interpret the act, that will prevail over and above the Income Tax Act provisions. So, the judge-made law, with my practice experience, limited experience, there are 30 postulates, 30 principles. Out of 30, today I have selected to present before you 12 principles. Thereby, to some extent within the given time, we can understand. Because ultimately that is the Court will decide what is the real income. Not necessarily add less. In fact, how many of you are aware? 6 months back, one advocate filed a case in Delhi High Court. Why the chartered accountant should be allowed to argue in the tribunal? For the past 65 years, they are arguing. No, chartered accountant shall not wear a coat and then come and represent before the Ministry of Law. That is, income tax tribunal is not part of income tax department. The law ministry means only advocate should plead. Chartered accountant shall not plead in Delhi High Court. CA Institute is a party representing, but in spite of it, eminence from Chennai, I should give my acknowledgement for the time sacrifice they are making. Approaching Arvind Dattarji, who is doing free service, chartered accountants side, he is now representing, doing free service. I should acknowledge from Chennai that we are saying, Income Tax Act itself recognizes chartered accountant 288. He is the person doing the tax audit. Why? The income of a business can be computed. Without accounts, how can they compute? So, audited accounts, audit report, and then from the audited accounts net profit plus minus. This is in the act. How can another person better than a chartered accountant can interpret the accounts and then arrive the business income? That's how one chartered accountant is an accounting member in the tribunal bench. That is there. You recognize the chartered account service in the bench, but in the argument you don't recognize the chartered account service. What is it? That is the plea taken by our G. The arguments are going on, still decision had to come. So, the point I would like to drive as chartered accountant, though it is not part of our syllabus, we should, beyond the Income Tax Act, what the law is deciding, what the courts are deciding, how they are. The thing what every one of you, I urge, because I have done my BL in 1980 along with my CA. I completed my CA in 79 May, and then I completed my BL in 1980. So, unless you go to that interpretational provisions, especially Indian Evidence Act, now replaced 3 new legal statutes interpreted. The evidence under the Income Tax Act. The income tax authorities need not strictly go as per the Indian Evidence Act. But the principles in the Indian Evidence Act are 100% to be considered in the income tax assessment. Why should they consider? Why should they consider? Because the income tax officer is a quasi-judicial officer. What is the difference between a judicial officer and a quasi-judicial officer? Can anybody tell me? Instead of asking anybody, I will point out a person and ask. You have to tell. Otherwise, somebody else will tell and you will be Shukta Avastha. Please be 100% Jagaruka Avastha. Don't be in Shukta Avastha, please. What is meant by difference between judicial officer and quasi-judicial? Income tax assessment is also section 144. What you will call? Section 144. Best judgment. In GST officer, assessing officer, what you call? Adjudication. Judge. Adjudication. Section 1 for best judgment. So what is the difference, exact meaning between the judicial officer and the quasi-judicial officer? Yes, sir. Your person. No, behind you. Sir, can you tell me, sir? Yes, sir. What is it? Sir, not less than 25 years you would have put in as a chartered account service. Physical or faceless. You are filing your wakalat and arguing CIT appeals also. Definitely we are all dealing with income tax. We are here to learn. We are here to learn, unlearn and relearn the income tax act here today. So what is the difference between, sir, anybody sir, yourself sir, first person. What is the difference between a judicial officer and a quasi-judicial officer? Please sit down sir, please, kindly, I don't want you, please.
In general sections, they are executing what the income tax department takes through other execution of the work. But in specific sections like 144, they are judicially they are acting as a method of judgment on the basis of the equity, natural justice they have to apply.
I agree.
273A like that.
You are right. I agree. You are telling only about 144 example. It doesn't matter. What about 143.3? It is also quasi-judicial, sir. That's what I want to say. 143.3, scrutiny assessment officer is quasi-judicial.
Just a court officer who can decide based on evidences.
Sir, Satish, next speaker. Please sit. I don't want you to stand, sir. Please, everyone sitting only give them.
Can take evidences on record and evidences surrounding those evidences.
Okay.
That even things beyond evidences, he can take a view and conclude.
I will give you a fundamental difference, please. In every judicial proceeding, judge is a neutral person. The plaintiff will file the case. The original suit he will try to pursue through an advocate. So, your income tax assessment is also a civil proceeding. Your income tax penalty proceeding is a criminal proceeding. If it is a criminal lawyer, the suit will be filed by the sometimes private criminal case or say government, mostly all the criminal cases, it is a public offence. So, Indian Penal Code, the government will file the case. So, in both the civil procedures and criminal proceedings, the judge will be a neutral person. The arguments of for and against will be by two different parties. They will produce first their evidence. In the income tax also, assessment is a proceeding, quasi-judicial proceeding. On behalf of the assessee or assessee himself is producing what he filed is correct. To that extent, evidences he will build up and file. So, in a civil suit also, somebody else, the defendant, the plaintiff, whereas the respondent, in criminal case you call it a defendant. So, the respondent in the civil suit say, no, that is not a reliable evidence. That is, contention is not as per law. Simple example, nowadays thousands of cases, respectable women CAs are here. Many sisters filed cases against brothers for share in the property. The brother is not allowed to freely use or say have the possession and enjoyment of the father's property. This sister will file a suit saying that I am also entitled to as per the Hindu Succession Act section 6. So, the sister will produce, this is my grandfather's property, some evidence. My grandfather gave 2 acres. My father made it 10 acres. My brother is enjoying all the 10 acres, being the only son and I am the only daughter. So, I am also entitled to 5 acres. She files a suit. She being the plaintiff, she tries to file the evidences that father has no self-acquired property. Everything is inherited. From inherited 2 acres, he made the 10 acres. Like that, she filed. What is the defendant this boy has to do? No. That 2 acres he lost first of all by doing a business on behalf of the joint family. And then he went for employment. With salary savings only, he brought again the 10 acres. It is his self-acquired property. Thereby, his self-acquired property, he wrote a will. For inherited property, he cannot write a will. So, I am the son, got through will. This is the document of my sister has not told about the will to the court. This fellow will defend. So, the judge should decide based on the facts and evidences, is it inherited property, is it self-acquired property, whether she is having the right or not. So, judge is a neutral person. Judicial proceedings are all judge as a neutral person, considering both the arguments will decide as an unbiased person. In the income tax assessment, the income tax officer is a quasi-judicial officer. He himself is the prosecutor, plaintiff on behalf of the income tax department. He himself is the judge to decide what provisions of Income Tax Act will apply? You understand? Quasi-judicial means he is discharging as a judge and also he is a plaintiff. That's why you call him as quasi-judicial. So this principle is recognized by the court in all the income tax appeals. You are a quasi-judicial officer. You have taken a biased decision. As a quasi-judicial officer, you should be unbiased. Don't get influenced by your employer's salary. You be neutral. You decide the case based on principles of natural justice, based on the evidence, which is sometimes every business return when it is taken up for scrutiny. You think of a shop here, a mobile shop, a TV shop. Naturally, he is paying rent to the house owner. The officer will say, prove the rent expenditure. Sir, I have taken his PAN number. Every month I paid with TDS. His TDS number is there. He filed the return also, copy also I am giving. This how rent TDS is there. He is acknowledging the rent receipt. No. I don't believe. This is a make-believe rent. You have to boost up the expenditure. Actual rent would be, say, per month 50,000. You boosted it up to 1 lakh because that fellow 12 lakhs is now no tax. You boosted up the expenditure. Real rent, reasonable rent is only 50,000. Officer will write in order. So, even genuine thing to prove as genuine. If I ask you, yesterday you have taken breakfast, prove me, I asked you now. Can anybody prove that yesterday you have taken breakfast? Like that, the majority assessments result in thousands and lakhs of crores of demand. Because I am not satisfied. It is true. I may speak 2 hours. I may not satisfy you. Because if it is unbiased, you may get satisfied. If you are biased, you will not get satisfied. But that's not the law expecting. Law expects you to be unbiased. In the general human probability theory, one theory. I am going to give 12 such theories. So when you go to appeal, what you should say? What is the human probability, sir? Third building to me is State Bank of India rented building. You see, comparatively, when State Bank of India is paying the rent to a house owner for square feet 40 rupees, I paid 25 rupees for square feet. Is it unreasonable? Human probability is a theory. Number of income tax decisions are based on human probability. So like that, number of theories are there. Not less than 30 theories are there in the income tax appeals where the justice is done by some principles, not by the act alone, strictly by the act. So, we have to study, and I have taken the opportunity of presenting the case. Even under the new act, 563 sections, the last section, repealing section, what it says, whatever the applicable old law to the extent possible will apply. So, for this also one theory is there. That theory is known as a Blackstonian theory. Blackstonian theory says everything is available in the Google. Just like you search Blackstonian theory in the judicial process. What the Blackstonian theory says? The decisions given under the old income tax also will apply even in the new income tax act. That's what I want to say. So, even under the new income tax act, we are now here to do how the new income tax act will apply means no new decision necessary unless it is the opposite, contrary, unless elimination is there. All the old decisions, old provisions will apply. Provision section assessment order, you may write a new section, but the decisions, old decisions also will apply. This application, the judicial parlance, it is called as Blackstonian theory. So, as per that principle, the decisions of erstwhile decisions of the erstwhile income tax act also will apply to this. So, now we will come to the exact crucial issue. I will ask you before proceeding another question. Please be ready. A person, a retired teacher, while he was serving as a teacher for 35 years, he purchased a house plot. After retirement, he got some such money. Then he thought, why should I keep the money as FD like others? In the same plot, he constructed say 6 apartments. One apartment he kept a modern apartment for him, and the 5 apartment he sold. He was not an income tax assessee, never filed the income tax return. When he sold these 5 apartments, after completion he sold, the sub-registrar office, specified information, around 50 types of information will go to the jurisdictional assessing officer by pressing a button. Oh, this man sold 5 apartments. Issue a notice. That man has come to you as a chartered accountant. For the notice of 148, you have to file the return. My question, whether you will file admitting the capital gains, total sales minus cost of acquisition, capital gains return will you file, or because the officer may take Y capital gain, you have intentionally constructed 6 apartments. If you are for your own purpose, personal purpose, capital asset investment. For intention of selling, you constructed 6 apartments. Anything for business, selling, for profit, adventure in the nature of trade, business income. So officer may say business income. Will you file a business head income return or will you file a capital gains head return of income is my question. Yes, sir. Yourself, sir. You will file the capital gain income. Any other answer, sir? Capital gain only.
Capital gain only for 5 apartments,
Huh.
not for the 6th one, which is going to be maintained for itself, including the land cost also.
Please.
Land cost and the construction cost of that proportion of that flat which is retaining for itself will not be taken for capital gain. Only the balance 5 will be retained. Only when he sells it later on, then only the capital gains will arise on his.
So any other answer, sir?
Reinvestment also we can claim for this.
No. After completion, he got the money. No reinvestment is there. He utilized all his money, constructed, and 5 he sold.
Okay, before 1 year also you can reinvest on that context. No.
Sir, with his retirement benefits, he constructed all the 6, sir. Not the sale proceeds he constructed. 54F. So if I am the person, I will not take exclusively capital gains. I will not take exclusively business. I take business come capital gains. Why? Reasoning I am giving. The person purchased the house plot 10 years back, now constructed the building 6 apartments. The income tax proceedings, business head income, you should prove the business expenditure. Generally, charging section 28 to general section 37, wholly and exclusively for the business sake, you should have incurred the expenditure subject to more than 10,000 no cash payment, anything contract, TDS, by chance your business turnover is more than 1 crore, your TDS sections will apply. So, risk is comparatively more in business head rather than capital gains. Number 2, when you come to capital gains, you have to prove consideration minus cost of acquisition. Proving cost of acquisition many a number of times as risky as business. Proving cost of 6 floors he constructed means for the plumber also would have made TDS. Plumber generally contract all the 6 floors, do that. Electrician, you take this much lump sum money, execute the work. No TDS, no identification, no expenditure. Sometimes when the laborers wants cash, immediately you will give the cash. Otherwise tomorrow he will not come. He says. So both the risks are there. So what I say, you go by the middle way. The landowner, on the day he got the plan approved for 6 apartments, he converted his personal asset into a business asset. Section 45(2). The advantage of using the section 45(2) is the capital gains will arise. You should file the return with capital gains, but don't pay the tax. Tax liability will not come. 45(2) section says the tax liability will come in the year in which such stock in trade is sold. So here the sale is land come building. For the land you arrive with the capital gains where 100% cost of acquisition is provable. Land market value, sub-register fair market value as on the date of you converting the land into this thing is 45 whereas such capital gains you can pay only in the year of sale. So every consideration of the flat divide into land value plus building value, superstructure value. For the superstructure you take the business income. For business income also you don't file just like your accounts. He is not a businessman really. No books of account. Don't write the books of account. You are filing the business income. Go by estimation method. Percentage of estimation method. I sold 5 apartments. That is my turnover. My opening stock is land. My building construction expenditure is business expenditure. My turnover is this. If we had sold spread over 2 years business turnover. For the 2 years business turnover, I have evidence documents registered. Estimate 10%. Estimated 10%. You file return in response to 148 notice. No audit report. Nothing doing. 100% safe. Because number of decisions in the works contract. Business head. Civil constructions. 8% is sufficient. 6% is sufficient. Number of decisions. Go by the judgment law. I am not a businessman, sir. I am a retired teacher. But I have carried on the business. I don't know about the provisions. So I estimated 10%. So that had the same been totally capital gains, short-term business, that is instead of business, if you go for the buildings short-term capital gain, land long-term capital gain, purely capital gains return if you file, the officer will say, building acquisition cost, vouchers you file, cost of acquisition file. Can you 100% satisfy the vouchers for the building short-term capital gains? Can you file the vouchers and satisfy him? 90% you satisfy, 10% he will add to the capital gains. What you have admitted, he will add 10%, which is very risky. So, go by the decisions, ignore this. Simple example I have given, like this, number of examples. I am going to give you few of them for lack of time. I have given in my PPT not less than 50 decisions in 50 different circumstances I have given, quoted, decided cases. But anyhow, to the extent possible, I will try to inject into your minds that what is the crux of the problem, how to attempt the problem, how to meet the ends of the justice by taking different alternate arguments. Still, shall I have to come this way? Okay. So, you are the tax auditor, business income, let us take as a practical example. Because mere house property, mere capital gains, mere other source income taking up scrutiny is very less. Generally, these business income people only will get the notices, this thing. So, I want to ask you, for 25-26 assessment year, you have filed the returns in 2025 itself. If such a 25-26 assessment year return has to be taken up for scrutiny, what the officer has to give the notice? First notice. What is the section, sir? Huh? No, 148. Ennama idu? Hello? Are you? Hello? Ennama? 143 notice has to be given.
Within 6 months from the end of the assessment year.
That is now 3 months. So next month, June 26 is the last day. By 30th June, if he wants to convert into scrutiny, the return already filed. By chance he misses that 143.2 notice. Sometimes without issuing 143.2 notice also, some people have done the assessments, and when you go in appeal, When there is no 143 notice, total assessment order is wide. Number of decisions. Every minimum thing prescribed by the statute has to be necessarily followed by the assessing officer. So if 143 is missing, then after 1 year, 2027, he wants to give the notice. Then the section 148 notice. What is for 148 notice? Any income escaped according to him. Then, before issuing 148 notice, now the present procedure is? No, not necessary 133.6. 133.
There should be notice.
No.
There should be notice for reassessment.
So, 148 is a notice for reassessment under 147. Assessment will be done under 143. Normal scrutiny 143.3. Income escaped assessment 147. To assess under 147, notice shall be under 149 and within the times specified. You should read 149 with 151, the authority 151. So, proper authority. What is why proper authority? Why proper time limit? So, for example, I will come to the next slide. So, here reasons for selection can be 26A is mismatch. One beautiful example I will give. Live case I will give. ICAI Bank engages private persons for loans recovery. Axis Bank, many banks are now noticed. Loans recovery. Not asset say recovery. That is after becoming NPA auction, then they will transfer it. Not this loans recovery. So they give the details. Overdue is there. You approach him, collect the money. Not in your account. Collection should be to the bank. But you go persuade him. They use all sorts of methods. First degree, second degree, third degree. Somehow or other they collect the money. This fellow gets the money. What this fellow gets the money is based on the collection. So based on something if you collect, which section will apply? 194H. 194H says commission TDS. So what is meant by commission is given as an explanation to 194H. If you read 194H, what is this commission means? If you read a beautiful definition. Commission means it includes brokerage for any goods or services as an agent done. So here this fellow has done the services, not the goods selling also commission can be there. Dealt. Services done. Commission. So the ICICI Bank by mistake instead of 194H they have given TDS under 194J. This fellow received 2 crores. This fellow 2 crores. He admitted under the head business. It is only commission I got. I employed 30 people. I employed 2 vehicles. Depreciation. So, throughout the year, I maintained 2-3 offices in different locations for 3 districts put together. So, this fellow admitted the business income. The officer has taken up for scrutiny. What he says? Your turnover is accepted because they uploaded. But the turnover is a professional income. For professional income, you cannot say business tax audit, not this thing. So, you have less than 50% income you have shown. Whereas it's not a business income, it's a professional income because he deducted. Based on that, he made the addition. So, when he gives the notices, for every scrutiny notice like this, number of this thing is there. Preliminary thing what you have to do is go to the root cause of the notice. What is the root cause? He is now open. Earlier, reason to believe that the income escaped. Now the reason to believe escaped is now extra. The government wants less litigation. This 2026 Finance Act amendment, 3 amendments, important amendments also to reduce the litigation. Because for the past 6 years, 6 lakhs appeals were filed, first appeals. In the past 6 years, out of the 6 lakhs, they could dispose only 1 lakh appeals. Even today, 5 years old, 6 years old, 5 lakh appeals are pending. They said 36 lakhs crores is the money involved in these appeals. Every year budget they will give what is the pending litigation. They want to reduce the litigation. So if they want to reduce the litigation, the intention of central government may be all right. Officer should have the same intention of reducing the litigation. No. Officer, what interest he will have in scrutiny assessment to reduce the litigation? My job is safe if I make more addition. When you go in appeal, he wants indirectly the litigation. His interest is not 100% to reduce the litigation. Because my job, I should be safe, sir. I cannot take accept. So every notice under scrutiny when it gives, as a representative, authorized representative, you should decide 100% that objection. I have evidence, conclusive evidence, 100% evidence. I can convince the officer. Oh, I will go give the reply. 50% of the story. Remaining 50%. He has taken up for scrutiny. Sometimes scrutiny causes will be sudden fall in the GPE. Take up for scrutiny. Till last 4 years he filed 8% income. This year he filed only 5% income. That can also be for scrutiny, red flag. The system computer gives comparing. So, can you 100% convince with your replies that yes, 5% is reasonable? So, it's a very big question. Because hundreds and thousands of types of business. Each type of business percentage of income will be substantially different. I am going to give you 4 case laws. If it is check discounting business, Bombay High Court said, alag securities, 0.15% income is most reasonable income. 0.15%. Check discounting. Banks themselves are charging less than 1%. So why here 256 crores turnover? He proved the genuineness. So 0.15% is reasonable. Bombay High Court in alag securities. So each business percentage of income will vary depending on the nature of the business. So when you are replying for the first notice itself, when the case is taken up for scrutiny, am I strong to convince the officer that what I filed the return is correct? If it is correct, you go. As per the act only, let the income be computed. Go on giving the replies. If not, come to the other side. There is every possibility, whatever we say, we may not be able to convince the officer. Then what is the best answer? You filed the tax audit report return. You admitted 4.5% net profit percentage. Now, earlier 4 years, 6% was their average. And if it is the same cause, or some small mistake like 26 years mismatch, or some other thing, instead of fighting, if it is a small difference, now in response to 148 notice, what the section 148 notice says, we found some mistake, please file a return in response. Already you filed the return. In response 148, please file the return. They will give 90 days time as per the act. Even if they give lesser notice of 30 days, you can ask for time, and within 90 days, you file your return in response. What you should file? Admit that mistake, not specifically, yes, it is a mistake, don't write. Please ignore my books of accounts. Please ignore my earlier return. I am estimating on my turnover 6% income. This is only the thing I am filing. File 148 return, only 6% income return. Because number of decisions say, whenever the books are rejected under 145.3, whenever the books are rejected under 145.3, 145.3 says, if there is no proper consistent accounting method, no income computation disclosure standards followed, no documents or information reliably given, then 145.3 the officer can reject the books. Why officer? You yourself reject books of account. You got the right. 90% of the CAs. Is there any CA in this hall who said, I rejected my own tax audit report and I filed the response under 140? Any CA, please raise the hand. Because our mind is closed. We are trained. What to certify, you say always different. Yes, right. What right? The assessee has done right or wrong. We have to sit in judgment. 90% you would have done as a human being. 10% is not. Even my own son, if he conducts a business, I am the auditor. Can I ask my son 100% do with OHS, Income Tax Act? I studied. Business doing is its own difficulties are there. So then you reject your own thing. Simply file 6% return of income, saying last 4 years average is the 6%. I am admitting my income under with 6%. Because court said whenever the books are rejected, his earlier 4 years average shall be the basis for best judgment. Number of decisions. So my own business has got its own peculiarity, because number of decisions say that past 4 years average can be taken. I am taking that 4 years average, filing 6%. Thereby your mistake is washed off. The officer cannot. Why this should be done? Keep the end result. As you have filed the tax audit report, as you rely on the tax audit report is correct, that, if you file the 148 return also, officer will somehow or other make a same income. You filed same income, same rate. The officer somehow or other is not satisfied, will make the addition. Along with that additional order, what you will receive? Misreporting income notice. 270A. It is under reporting or misreporting. Because I issued the notice, you have not admitted also the addition resulted because of my roving inquiry. So, in addition to tax, please pay 200% penalty. So, again you should fight for penalty. Whereas, whenever the income is estimated, 270A subsection 6 says, whenever the income is estimated, it is not under reporting. Unless it is under reporting, it cannot become a misreporting. Keeping that penalty in view, now you paid even 1 rupee more tax voluntarily. Keep the penalty in view. Because we have to protect the assessee. Assessee, how he knows the 270A penalty, 200%, all this assessee knows. You say, arey yaar, pay 10 rupee more and then file the 148 tax. Sir, why sir, at the time you didn't say that this notice will come this way. Arey yaar, I don't know, they have found. You got out of 100, 2% only taken up for scrutiny. All the 100% cases are taken up scrutiny. They have no time. They have no wherewithal. How many percentage do they take up for scrutiny? Less than 2% every year in the past 20 years. Every year, out of returns, less than 2%. You are the one unfortunate. Maybe mistake. Let small amount pay. Forget. No penalty, nothing. That should be the approach. So, depending upon the mistake, gravity of the situation, you should sit in judgment and you should try to wash off rather than fighting unnecessarily when you cannot satisfy the assessing of, especially faceless assessment. That fellow will not follow the principles of natural justice. We cannot. Again, he says, you go to your appeal. You, all your legal judgments, you file an appeal. I will make the addition. Whereas when you yourself agree, where is the question? Simply wash off. So, there can be several things. In the newspapers, any journal, weekly journal, if you see, minimum for the past 3 years, I am seeing every week journal I open, latest case law, every week I am seeing bogus purchase, bogus sales, bogus purchase, bogus sales. Every week, minimum one decision is coming. So, for that also they will take up for scrutiny. What you should say? Sales omitted, purchase omitted. How many of you have seen the newspaper on March 8th, 2026, throughout the country, out of 62,000 cases of restaurants, they have selected around 60 cases in 42 cities, conducted same day, same time, restaurants survey under section 133A on March 8th, 2026. Newspaper, all newspapers. It is known as, sir, Pet Puja. Pet means stomach. Pet Puja software. What is the software? Only one or two are saying. Nobody has heard it. Nobody. You should read, sir. Income tax assessments means this is how you should see. What is this Pet Puja? You are right. So in Gujarat, in 2021, one intelligent person, normally Gujarat intelligent persons only. So one intelligent person from Gujarat, I have developed a software. Restaurant people, whoever want, please use this. Pay me small amount only. Why, sir? It is not accounting software. Hello? It is not accounting software. It is a marketing software. So all your sales, you sit at house, let your restaurant manager, let your restaurant people, they do that. From your sitting house, this my app use. Every minute how much sales happening. Wonderful. Every owner wants that. Second line. At the end of the month or middle of the month, as much sales you want to avoid, you ask me, my system will reduce it. 30% sales. Only cash sales. Whatever sales you want, my system will, but that system removing not your employees. Your employees only order booking, cash collection, this, that. For the owner, I will give you a password. So, you ask me to reduce it through the password, then the owner can reduce. So, happily, nearly 1 lakh of restaurants, wonderful software, all the cash sales to the extent possible we can avoid, income tax avoid, GST avoid, happily used it. One such happy user in Hyderabad, Paradise Biryani, the income tax people went there, inspectors, in February 26. They observed the sales. They got such, because it's such a popular, restaurant 100 people are sitting. Everybody is paying. Everything bill. Whereas in the income tax return, not even 25% of the sales is coming in the past 2-3 years. Somewhere else something wrong. Then they asked that fellow, they observed for 2 weeks. What is the last 2 weeks? Fortunately, that 2 weeks sales already that fellow, instead of doing at the end of the month, very big process. Every week let us do, remove 30%, 40%. Ask that fellow, Gujarat fellow, pet puja software, you remove. Then the income tax people, this is possible at a split of a second. See, if you are writing computer accounts, remove it means book construction, so much time it will take, no? That software flow has produced all this facility for you. So then immediately they contacted software fellow. That software fellow said, this Paradise fellow said, sir, not only I, so many others in Hyderabad city, so many cities are also using the same software, sir. Why you only are? Same software. Same software. Then they went to the Gujarat software fellow. That's what, sir, I am doing it for the past 6 years. Nobody complained. They are asking I am doing. What is it? They wanted it. I am a software provider. In India, abettor of a crime is also equally 100% liable. How many of you know the section 271 ADA in the Income Tax Act? How many of you are aware? Section 271 ADA. What is that ADA section? Section ADA 271 penalty section. That says, that is I think equal to 444 in the new Income Tax Act. Just like that you can cell phone search now. 271 ADA equivalent section 444 in the new Income Tax Act. That section says, subsection 1, anyone who omits an entry or who makes an entry which is false is liable for penalty for evading the income tax or for reducing his income tax liability, is liable for equal to 100% of that entry. Penalty section 271 ADA. So these income tax people, that subsection 1 applies to restaurants who omitted the entry or who made the entry, 100% penalty. Whereas subsection 2 of 271 ADA, subsection 2, what it says? Any person who helps the first person also is 100% liable for that penalty equal to the entry, omitted entry made. So they asked this pet puja software fellow, you are 100% liable for all that entry if you don't give the information. If you give it, we will try to save you. That's the technique income tax people, whenever they go, they use that. So that fellow said, sir, do you think I will preserve all the data of 6 years of all these 1 lakh restaurants in my, everything in the cloud it is there. Cloud, no problem. Sir, it will take 1 month for me to download. Don't worry. You give the password, we will download. They went to the, throughout India for income tax people, there is one cyber analysis lab. So, in 4 days, 46 terabytes data they unloaded by February end. In 4 days, they downloaded, analyzed 46 terabytes data. They have understood all this. During this period, this Pet Puja fellow never informed any restaurant. They have come, they have taken the data, be careful. That also he didn't say. Why should he say? Because if he says that also central government is monitoring his cell phone, his email, everything, central government. So he kept quiet. By February end, they decided it is impossible to 62,000 people, restaurants throughout India, doing survey and then red hand catch is difficult. So they selected only around 60, top 60 who evaded more than 10 crores. So then on March 8th morning at a time throughout India, they conducted the 133 survey. So I got 4 cases, such cases after March 8th. Then what they will see, sir, somehow we used, now the department has come. What is the per year turnover suppressed? 5 crores, 7 crores. You all think restaurant means it will be in lakhs or thousands. It is in crores suppressed turnover. Now if such suppressed turnover fellow comes to you in the month of March 15th, what you should have done, have you done it? What I have done, I am going to tell you. What you will do? A client comes. For the past 4 years, 5 years, he has done this Pet Puja software. March 8th raid, 1 week they go around and ask some advocates, some tax experts. One expert will say, Ariyar, it is his evidence in your books or nothing. When they come, only this is there. This what he actually done is not there in his computer itself. It's all marketing. Thank you, Satishanji. My friend from Trivandrum, next speaker, 12 to 2. He is helping me, you see. See, a chartered accountant should have that much affinity for a co-CA. So, I thank you, sir. So, if you are the auditor, by March 15, that fellow has come, what you would have done? Can anybody tell me, sir? Answer, sir. Sir, yourself who dealt the Pet Puja software, what you have done? Sir, our mic kudunga, our silver, answer. Ningale, sir. Advance tax only for 26, 27, 1 year, whereas you have done for 4 years, the data is there 4 years available.
Also for updated returns we need to.
By which date?
By 31st. 4 years.
So my friend who is going to deal the next session topic is returns filing, returns dealing. He gave the correct answer that by March 31st, the income tax department conducted the survey on March 8th, issued the summons on March 10th, March 14th, recorded the sworn statement, showed the evidence with the department, which he cannot deny. On so and so date with your password, this much turnover is reviewed, yes or no. This fellow has to say yes, he cannot give a, which is a fact. So, department is having the conclusive evidence. Many advocates, income tax advocates, are their evidence, don't worry, we'll file, no. At the end of 4th year or 5th year, double, triple amount with penalty. Rather than that, the income tax act has given you the advantage of updated return. And what is the updated return amendment in the 2026? A person before January 31st, the Income Tax Act was saying, 139 subsection 8A was saying, updated return cannot be filed in 3 circumstances, let us say minimum. A, if it is a loss return. 2, if it is already an updated return. Second, updated return. 3, if it is covered by 133A or 132, you cannot file updated return. So these are the negative conditions for updated. Otherwise, anybody within 4 years can file the updated return. Was there up to January 31st. February 1st, what is the amendment they brought? Keeping all these things in view. Even in circumstances where 148 notice is given, That means already the information got a clinching information in the department. Even then you file the updated return. That means you accept this thing. Provided 10% more you have to pay. Updated return 1 year delay, 25%. Second year 50%. Third year 60%. Fourth year 70%. In addition to that 25, 50, 30, 50, 60, 70, another 10% if you can pay, you can avail immunity from penalty and prosecution. This is the central government's intention and legislature. So to protect this pet puja used fellow, as he is no other go, by March 31st, I filed 4 updated returns saying, now for filing the updated return, again 2 possibilities. The income tax department will say, you filed the tax audit report. That means all your overhead expenses you have claimed. All your overhead expenses you have claimed. For additional sales what you have omitted, you would have omitted the purchase cost only, proportionate. Where is the question of overheads? So why can't I add 30%? Every portal fellow generally will have 30%. 30% on the omitted sales I want to assess. There is a possibility argument. Number of decisions confirmed also. If it is only suppression of sales, only GP can be added, not NP. Whereas these restaurant fellows all are having 4 to 5% net profit. You search in the Google, what is the average net profit of a food restaurant? You will get 3 to 5% only. So the updated return, if I ask that fellow to pay 30%, sir, I have to sell all my assets. He cannot pay. So what I have to do? I should admit 5%, because this past 4 years average is also net profit is 5%. So on the extra sales also admit 5%, file the updated return. I filed on March 31st. So live examples I am giving, thereby in response to scrutiny notice, causes of scrutiny and the remedies. So 25% of the scrutiny cases are, the computer will compare, income tax computer will compare your admitted turnover in the return and your total credits in the bank account. Total credits means cash deposits or other credits also through bank. But normally, if a businessman is having 2-3 bank accounts, interbank transfers also will be there. The income tax software is not eliminating that interbank transfers. He would have sold or admitted a capital gains. That capital gains gross receipt and business turnover put together, it is not comparing. Only business turnover, bank credits. Issue a notice. If you are sure that you have not omitted anything, reconciliation is done at the time of filing the return or at the time of now after issuing notice. If you are sure, go positively, don't admit any income. But if there is a possibility that something this fellow has omitted, the real sales also as cash withdrawn is re-reported, this fellow accountant would have written real cash sales as cash deposited out of the available cash balance. Some people will do no accountants to reduce the real cash sales, they would have done it. Then better, at least in response to 148 notice, admit that extra cash portion as some sales suppressed, avoid it or mistakenly omitted. Now you admit, because you cannot reconcile and then 100% sure of proving correctness of the account. So many causes how you react in the scrutiny, whether under the old act or the new act, the same provisions. So this is the old act, this is the new act, assessment provisions, wording, so same ditto, only sections are renumbered. So the techniques, the approach should be more ground realistic based on the judge-made law. I am telling this 10th time. How many judge-made laws are there is my job here to present and bring to your awareness. So these are the sections ditto, nothing changed. All the assessment procedures, old sections, nothing but same thing copied with a renumbered. That's all. So the first, our Chartered accountants are experts in taxation. It is true. Our expertise should not be dominated by believing the other fellow. Believing the income tax officer is always right in issuing a notice. So, we always, excuse me for telling this word, 90% of the CAs before the income tax officer, so much submissive. You are always right, sir, some mistake my assessee has done. That should not be the approach. Officer also human being, he may also do some mistake. What type of mistakes he can do? First you examine, then you come to this. Because section 292C, section 292B, first of all, section 292 capital B in the Income Tax Act. Even if a notice is mistaken, if the assessee participates in the assessment proceedings, notice is valid. You should have objected in the first opportunity. You have not objected. Later on in the appeal, because you engage in an expert, you say notice is invalid. You should have told that in the first response of notice itself. So, whether the notice is valid, number of times the income tax RMS, risk management system, gives them red flag. For example, my father 5 years back sold a site for 80 lakhs. He has not filed a return. And he gave that 80 lakhs to children somehow or others. Okay, it's already his father's wish. Why should I disturb? Now, father died last year. The income tax people, income tax data every year, every month they goes. But they select for scrutiny when time barring. Above 50 lakhs, 5 years. Below 50 lakhs, 3 years. In the 5th year only they give the notice. Time barring. Because already early year time barring notices they have given, they have no time. So still time is there, last minute. So by the last 5th year they gave, my father died last year. 4 years back transaction. So now 5th year they gave the notice. Notice has come to this, because I and my father lived in the same house, let us say. So, notice has come. Officer, in which name the notice he will send? Father's name. Officer, is he aware of the death of the father? He sends the notice. What should I do? Sir, elderly sir, பெரியவர் நீங்க தான் சார், நான் போட்டேன் ப்ளீஸ். நீங்க நோட்டீஸ் வந்தா என்ன ரிப்ளை பண்ண போறேன், எப்படி கொடுக்க போறேன் கேட்கறதா? பரவாயில்லையா? Notice has come in the name of my father. What I should do? என்ன சார்? You will file the return. Legal error. If I am there, I will not file the return. அவர் கொடுத்த நோட்டீஸே தப்பு சார். டெட் பர்சன் நேம்ல நோட்டீஸ் கொடுக்க கூடாதுன்னு இன்கம் டாக்ஸ் எழுதியிருக்கு சார். A notice shall not be given to a dead person. That notice is invalid. Invalid notice போய் நான் ரிட்டர்ன் ஃபைல் பண்ணணுமா? தேவையா? இன்கம் டாக்ஸ் ஆக்ட் செக்ஷன் 159 சொல்லியிருக்கு. லீகல் ரெப்ரசன்டேட்டிவ் ஷால் ஃபைல் தி ரிட்டர்ன், ஷால் டிஸ்சார்ஜ் தி டாக்ஸ் ஆஃப் தி டிசீஸ்ட். இன்கம் டாக்ஸ் எழுதியிருக்கு. பரவாயில்ல, வச்சுடுங்க. Why do you worry? Notice, is it valid? Invalid. Invalid notice, keep quiet. The same decisions, number of decisions, High Court said it is not the duty of the legal representative to submit the death certificate. Just because he has not submitted the death certificate, you made the assessment. Assessment is invalid. You should have inquired. You should have inquired properly whether he is alive or dead. If there is no response, you should have inquired. Number of High Court decisions binding. You summa irunga. Why? Then who is the legal representative? What is the correct procedure, legal procedure? Can anybody tell me, sir? Who definition of legal representative? Not the legal heir. The Income Tax Act never used the word legal heir. The Income Tax used the word legal representative. What is the definition of legal representative? Can anybody tell me, sir? Income Tax Act. Unless you are aware of this legal representative definition, how can we practice? There may be a number of cases of not necessarily death person. Amalgamated company, landmark Supreme Court decision in the case of Maruti. Maruti company, that Noida, promoted a subsidiary Maruti company in Gujarat. They want to establish manufacturing. That subsidiary company, they acquired the land. Ultimately, they disposed of the land and then amalgamated the subsidiary with the holding company. The Income Tax officer gave a notice to the subsidiary company, made the assessment, and the subsidiary company notice is invalid. On the day you gave the notice, company dissolved, company liquidated, got merged with the holding company. You should have given the notice to the holding company for the sale of the land, not to the subsidiary company. Notice is invalid. Same rule applies to a dead person. Number of partnership dissolved, number of decisions. We should know legal representative definition means a person who got by inheritance the deceased's property is the legal representative. The liability of the legal representative, 159(1) legal representative liability, 159(6) says, to the extent they inherited the property, to that extent only the tax liability is there for the legal representative. No penalty liability. For not filing, misreporting, so many things may happen. For penalties, legal representative is not responsible. For tax, not discharged by the erstwhile deceased. Tax not discharged by the erstwhile deceased to the extent the legal representative. Legal representative is, out of 4 sons, father wrote a will for only 2 sons. These 2 sons only are responsible, not the other 2. Definition of legal representative. Andalo padichu parunga. So you should know which notice is valid. From so many angles you should see whether the notice is valid. From so many 6 types of tests you should see for a very notice. Timing, status, amount, authority sanctioning the notice. Officer can himself give. Up to 3 years principal CIT. Beyond 3 years principal chief CIT. Whether he got that order he should enclose along with 148 notice. I got the approval from the principal chief CIT to give this notice. That word. If it is missing, notice is invalid. So you should examine this. First, don't think that he is also a human being. Maybe error. Number of decisions they have erred. Already precedence is there. So that's how we should do it.
So you've been talking a lot about, the judge-made law and, its importance and all that. Now in 148 notices, sir, isn't the procedure in which a 148, a 147 proceeding and a 148 notice in which the order in which it should move, hasn't it been laid out in certain judicial precedents, sir? Like for example, assuming in a case where we have objections to the reopening of a particular assessment. So isn't the officer first required to dispose of those objections before proceeding with the taking up of the actual case? Because the specific reason why I'm asking this is the e-proceedings portal, the e-proceedings dashboard. See, because I'm dealing with a live case here. So where we have objections to the reopening of a particular assessment. So the proceedings is not the e-proceedings portal, the dashboard is not allowing us to record those objections there in that particular portal. It once you say submit response, it automatically takes you only straight to the filing of the return thing, where it says you have to file a return because the notice says within 90 days you have to file a return. So how do we reconcile this sort of a mismatch here, sir? And what is the practical way forward, sir?
Yes, I got your point. I will answer. See, where already a clinching evidence is there with the department, now from 2021 onwards, for a person who has not filed the return, 148 capital A, small ABCD notices were there up to 2023. Now they are replaced by 148 capital A, subsection 1, 2, 3, 4. Pre-assessment notice inquiry. So the officer, based on the principles of natural justice, what evidence is making him to give a notice, making him to take up a 148 notice, preceded by a 148 capital A inquiry. So he will give a notice under 148 capital A1 inquiry. This is the evidence I have. Based on that, I presume that there is income escape. What do you say? Then 100% under 148 capital A subsection 2, you got every right to submit, the portal will allow. That is number 1. After you submitting under 148 capital A2, considering the objection you raised, your notice is invalid because it is above 50 lakhs. It is below 50 lakhs. My father sold for 75 lakhs. Its cost of acquisition is 30 lakhs. So the capital gain is 45 lakhs. Within 3 years you should have given the notice. Now time barred. Your notice, you cannot proceed under 148. With the documentary evidence, sale deed copy, purchase deed copy, all the evidences you have, you should file under 148 capital A2. The 148 capital A3, the officer shall pass an order based on the objections and based on the evidence. It is a fit case for reopening. This is the first part of the story. If he is not following the principles of natural justice, your objection, your evidence he has not considered in that order, writ jurisdiction also you can go. Or that your objection, even throughout the assessments you can continue without notice, without proper notice. This is first part. Second part, wherever there is already a 133A survey, there is already some evidence is there, again pre-enquiry notice need not be given under 148 days. Straight away 148 notice can be given. Maybe your case is covered under 133A. Already that 133.6 enquiry has already been. 133.6 says officer can inquire anybody. Even my banker, he can give 136 notice and record a statement. So already something is there. That evidence the officer is having. Then also you can say in response to 148 notice, yes, I am admitting my income, but what the 133.6 information you recorded from the banker, you should give me a copy as per principles of natural justice. Based on that, I will give my reply. Like that you can ask. So the earlier, before 2021, the officer believes, the court said, officer on suspicion not valid. Officer should have a reasonably believing means, not a reasonably suspecting. It is not equal to. Out of suspicion he cannot give the notice. Out of belief he should give the notice means a common man, by stretch of imagination I can suspect so many things. I can suspect even my wife. Rama himself suspected. So suspicion can go to any extent. That is not reason to believe should be there before issuing 148 notice. Second, already 143 scrutiny is over. Now again 148 notice is given. Possible, several cases. 143 scrutiny already happened. Again what will happen? After 143 scrutiny, I am a real estate businessman. Another real estate businessman is surveyed. There some transactions of mine are found. So my completed scrutiny assessment again shall be subjected to 148. Then number of decisions. Mere third party statement cannot be the basis for reopening. Is there any real material? Mere third party evidence or third party statement cannot be the basis for reopening. It should be a clinching evidence. Because, sir, in my diary I will write, Ambani has given me 30 crores. I invested in the Tirupati surrounding lands. If the income tax people come to my house survey saying that you are purchasing so many properties, where from the money? Ambani has given me, sir. See the diary already before you coming the diary. Can they go and give notice to Ambani saying that Ambani, you gave 30 crores black money to him? They cannot ask Ambani because the act is not saying that. I may write. Then what the answer I will give? Sir, to satisfy my wife that I am a strong man, I wrote so many purchase, sales, all these things. Say I am every day doing so much. My own diary cannot be binding on me. Court said that. What is the other evidence you should see? So the evidence is such a topic under the Income Tax Act. Whether third party statement, third party documents, dump documents, Xerox copies, or my own computer, so many entries, my own cell phone, so many entries. When they come for 133, they take print out from the computer, take my signature. Yes, these are the printouts from my computer, date, time, everything. Will it be binding on me? number of decisions not binding on me unless as per section 65 capital B of the Indian Evidence Act, as per section 65B of the capital B of the Indian Evidence Act, unless that such a computer is impounded, seized, seal potty, both my signature and the officer signature, send it to the forensic lab, take 3 hard copies out of it, then 1 sealed copy with the department, 1 sealed copy with the SSC, 1 sealed copy of the hard disk. Out of that proceedings is valid. Without this process, this is not an evidence reliable. Number of decisions. So, which evidence is the basis for 148? That 136 statement is a valid evidence. So, evidence under the Act is a 3 hours topic. Very big subject. So, we will come. I have 45 slides. I am in the 4th slide. 15 minutes time is there for me to close. So, the technical validity of the notices and orders. Please go through the number of decisions. Don't merely read and make your opinion by reading these sections. On these sections, assessee favored decisions you read, you will get. Department favored decisions also you should read. Here the department won, where the assessee has won. So, proper authority. This is one beautiful case. 7.5 crores tax demand becomes 0. 153.3. What is that 153.3? Beautiful case I handled at Hyderabad Tribunal. At least 30% of these 148 notices, no response. Because while taking the PAN number, some PAN number issuing fellows email ID would have been the PAN number attached email. Some email ID created. This fellow is not aware of this electronic notice. Then it will result into some 144 best judgment assessments. After 144 best judgment, what will happen? First 30 days officer will keep quiet. 31st day what he will do? Send a notice to this PAN number where the bank account, not the email. Notices for email. For bank account, simply PAN number touching officer. Anywhere else in India your bank account is there. Immediately send to the bank address. Tax due. 30 days over. He has not paid. He has not applied for stay of demand. He has not gone in appeal. Please, I am having the lien on the bank transactions. To the extent money is available, please send the DD. Then the banker will give a notice to the party. Your bank account is attached. Then that fellow will come to you. What you will do? You will file the immediate appeal. 10 days delay, 1 month delay condone. You will file the appeal. Even if you file a condonation delay, the appeal may be admitted, may not be admitted. But again, the 50% of the commissioners, whatever the evidence you produce in the appeal, they say, you should have responded to the assessment. In the assessment, what is available with you, you have not produced. Under Rule 46A, as a commissioner, I may admit the evidence or I may not admit the evidence. If it is, there is no reasonable cause for you, why you have failed to file the evidence, I need not admit. So, rejecting your evidence, he will also 100% concur with the assessment. Then you will go to the tribunal. Before tribunal, what you should plead? Before tribunal, any appeal you file, 4 possibilities are there. A, tribunal may 100% concur with the department. B, tribunal may not 100%. Yes, you are right, I am giving relief. Second possibility. Not giving relief, giving relief. Third, I will send it back. Now you are saying the CIT has not considered your evidence. But on the principles of natural justice, I will direct the CIT to again take it up. So tribunal can send it back to the CIT appeals to re-examine the evidence. The fourth possibility, be careful. Fourth possibility in this case example is best example. You can ask for, send it to assessing officer for de novo assessment. Because you have not filed anything before the assessing officer. Better, you will get the time and the demand will go. If it comes back to the assessing officer, the demand cannot be pressed by the assessing officer till the disposal of reassessment. So you plead for de novo assessment. Whenever the tribunal sends back to the de novo assessment to the AO, the AO has got a time limit to complete that reassessment. What is the time limit under 153.3? Anybody, sir? What is the time limit for the AO to complete the reassessment as per the tribunal's de novo order? 1 month, 1 week, 1 year. It has been reduced to 9 months. You are right. From the end of the financial year, 9 months is the time limit to complete the reassessment. 50% of the tribunal de novo orders now in the faceless scheme, officers are not able to complete, or they are not aware of this because it has come through principal commissioner. If it has come in the month of January, March transfers of assessing officers, April month. So this pending assessments, he has not given any charge taking over, and somehow it is missing. System is not 100% update. If the officer is not doing that reassessment within that statutory time of 9 months from the end of the financial year in which the tribunal has given the order, what happens? The result is my question. What happens? What happens? If you had filed the return, that return itself is 100% final. Whatever the addition made in 144, this, that, nothing will be there. That is fine. By that time, fortunately, that 3 years, 5 years time is over, no fresh notice. So 100% over. For example, your original return, you filed smaller income. In my case, it is a limited company, 2 crores is the returned income. They made the addition of 8 crores because of the bank statements. By the time the company is in financial troubles, they could not do that. So the demand is 7.5 crores. So no de novo assessment has taken place. So the returned income is accepted. During this process of appeal, if some amount is recovered, refunds or amount is recovered, refund shall be given immediately after the time lapse. As you cannot redo the assessment, please give me that extra tax refund. You should file a refund application. Refund has to be given. Decision. United Spirits, you search the Google, I have given anyhow in my PPT. United Spirits decision on this 153.3. The court said you have to give the refund because you cannot do the reassessment. What you collected is illegal. Give the refund. Original return is valid. So like that, the judge-made law, you should 100% know what to respond, how to do it. So these are all the things. Hello? 12 o'clock tea ready? In another 5 minutes, I will come. So the notice giving, authority approving, all these things. I have given number of decisions, latest decisions. So please read the judgments. My merely listening, merely knowing is not important. Understanding is important. Understanding means unless you read the decision once, twice, thrice, sometimes some decisions you have to read 3 times. Because the obiter dicta, the res judica, you have to understand what the reasoning given in the order. That reasoning should go. Then only you can apply it to other cases. Not merely knowing. So this is the evidence I told you under the Income Tax Act. We are all chartered accountants. Every street corner you will find an elementary school. 90% of elementary schools, they don't file the return of income. What they say? Our association itself said, without any registration under the Income Tax Act, without any approval of any application under the Income Tax Act, every year your income is exempt because your turnover is less than 5 crores. 1023 small 3AB section says, any income of an educational institution or a university, if its turnover is less than 5 crores, automatically exempt. Return filing condition is also not there. Only for 12 year registered section 11, return filing is condition. So everything is, but how the officer will know? Your bank account, 1 crore 75 lakhs cash deposit. Then system will say 1 crore 75 lakhs cash deposit, no return filed. They issue the notice. Then they issue the notice. Normally what our colleagues are doing? Sir, mine is a recognized school. I am covered by 1023 small 3AB. I am fully entitled to exemption. So you cannot say that 1 crore 75 lakhs is a income escape taxable. 1 page, 2 page reply you will write and you will file. You see, the bank account name is also Ramakrishna School. So school means you cannot give notice. Like that you will give the reply. Is it sufficient reply? In my view, a bad reply. For that notice, what you should have given? 148A notice. A, it is true, transaction has taken place. I am herewith giving a bank account copy. B, mine is recognized school. District Education Officer has recognized me as a school. C, I am running this for past 4 years, 5 years. Past 4 or 5 years turnover, how much gross receipts? My actual accounts, income how much? D, my strength in the relevant year. First class, second class, third class, this much people, this many students, this much is the fees. So many 3 terms deposit, everything bank evidence, number of students evidence. This is the acknowledgement I got with DCDEO that my strength is this much. 6, every year some government official will inspect the school. My inspection reports, I am physically inspected, solely existing for education is already evidence. All these you should file in response to one notice that 1.75 lakh bank deposit. What do you say? Why it is not taxable income? As I have satisfied all the conditions of 1023C, I am eligible for exemption. Evidences you should file, conclusive evidences. Normally we don't do that. Only letter you will write and you keep quiet. It's not correct. So that's how the response should be there. A conclusive response for the officer to consider holistically. Thereby your mere letter, anybody, I am also individual, simply I will open a bank account giving some bylaws to the banker. I may not run the school. Banker is not concerned whether I am running the school or not. Account is in the school name, some bylaws. I may close down the school. Still I will deposit, withdraw. How the officer can say that the banker is right, you are right? Nothing. Evidence should be there. The photocopy is not. Majority of 133, 132 cases. You will find Xerox copies of building agreements, purchase agreements, sale agreements. Normally photocopies. Original agreements would not have been there. Based on the photocopies, is it an evidence? Can they make assessment? Photocopy is a secondary evidence. Unless primary evidence is there before the department, secondary evidence cannot support the case. Primary evidence should be there, supported by a secondary evidence. Then only the case it can be. So photocopy is a dumb document. It cannot. Search the word dumb document in legal proceedings. Evidence Act says what is dumb document. So we should get updated with all these things. So 148 written filing, I gave you 50% if you are correct. You stand for your SSA, 100% what already filed, correct income, correct thing filed. Otherwise, estimate the income. 100% estimation is a Sri Rama Raksha, Tharaka Mantra. Estimated income solves several problems. So there are several decisions for several businesses, several percentage of income. So the normal computation also under which head you are doing. I gave you the first example. Is it business or capital gains? Or business come capital gains? Which head you are doing? Shares business, some other source income. For a big mall, the assessee will file the business income return, total gross receipts. Officers, no, your big mall 100% gave to 20 shops for rent. It is shop rents only. All the gross receipts is equal to 20 shops rent. It is a mall, one building. You are the owner of the building. All they are paying the rent. So house property. Supreme Court decision in Chennai properties, read, which says it is a business income, landmark decision. Number of decisions have come subsequently also after, based on the Chennai properties Supreme Court decision. So, which head of income? Correct legal status, correctly fight. So, this is the response filing also. Be aware of what you have already filed. Nothing is suppressed. But opinion difference, which head? You should have the supporting material with you. So, principles of natural justice, this is the word. In all the GST notices, number of GST notices are set aside. Yes, sir, what is this doubt, sir? क्या claim?
Case of estimation of income, if there is an investment mismatch, it will create a problem.
Sir, he has put a very right question. I will give now 12 o'clock over. My second speaker is waiting. So 5 minutes tea break is there. I will give one example. Then within 5 minutes I will within 5 minutes I will complete. A person owning 40 buses for the past 10 years, never he filed the income tax return. Never he has any GST registration. AC buses are also there. No GST officer gave a notice. No income tax officer all these years gave. Now the income tax officer gave a notice for all the 6 years. 10 crores turnover, 12 crores turnover in the bank account. Hurry yaar, why it is missing? And out of the 10 crores, 12 crores turnover is red bus booking is 4 crores. Goibibo, this bus, that bus, all online booking. This fellow is jolly well owner. And after receiving the notice, when he goes to a chartered accountant, why you are not filed income tax? I don't know, sir. I have to file the return. I am doing business, everything online, all bank transactions, everything. Then after receiving the notice, what you will do? As I advised you, percentage of income. Search transport business. What is the income? Number of decisions will come. Balaji Transport, Hyderabad Tribunal decision. I have given in my slide. 3% income is sufficient. So for all my 10 crores, 3%, 30 lakhs. Every year 30 lakhs, 30 lakhs to 36 lakhs. All the 6 years returns I will file. Is it sufficient is the question. By merely filing the estimated income, is there no risk at all is the question. Yes, sir. Risk is before filing the return, employ one accountant, all the 6 years books of account, as if it is a tax audit, you get written up the books of accounts, paka. Keep the accounts on your right hand. Don't file the books of accounts with the response notice. In the balance sheets, there is no net worth increase beyond that estimated percentage. You are safe. Your net worth increase is 3%. You filed 4% return. Safe. Your net worth, you acquired assets. You discharged your liability. All the 40 buses are purchased with Sundaram Finance, ICAI Finance. You discharge the liabilities also. Where from you will discharge? Out of income only. So your net worth is increasing. Net worth is one theory judgment law. Income can be assessed by net worth. Your net worth increased. Ignore you are not filed the, you are not maintained the books of account. Your net worth increase means what of business income? Where is the other income? So net worth you should compare. If net worth is more than that percentage, don't go by the decision. Your net worth, real net worth, admit the income respect to years. That is the answer. Yes, sir. So I am closing in 1 minute. I am in the 9th slide. Another 45 slides I am leaving. So just I am turning in each second one slide. Please go through. So the principles of natural justice is one of the dictum for both GST scrutiny assessments or say income tax scrutiny assessments. That means 3 ingredients of natural justice are there. If you search in Google all that these words, if you search what all I am giving will come in your internet. So alternate remedies. I started my speech saying Income Tax Act computation as per 28 to 44 is one part. Judge-made law computation of income ignores this computation, goes by the other methods. Those methods, 30 methods are there. I gave only 12 methods here as if this is a part 1. So we can have another session where another 12 to 15 methods are there, principles are there, how to determine the income. So this is how I will read the headings. Peak credit theory, telescoping theory, peak credit theory, number of cash deposits, withdrawals, number of bank transfers in and out, but only peak balance throughout the year. In the middle of the year, let us say the highest balance. That balance is income. Not every month. Credits only is not income. Telescoping theory. One income assessed, left side 68 addition. There cannot be simultaneously 69 addition. 68 addition is equal to source for 69 investment. Like telescoping, again 3 types. What are the 3 types? I gave in my slides. So similarly, the removal of difficulty theory, another theory. There, the example, 50C margin, 5% margin first time, 50C first without margin. Then for difficulty, I am giving 5% margin, no notice. Then again they made the amendment, 10% margin. No? Then 10% margin right from the beginning will apply. So retrospectively. So like that interpretation, if it is for difficulty, any amendment, any circular, any rule will be have retrospective. So similarly, principle of mutuality, you all know that all the cooperative societies or say residents association, clubs, social clubs, principle of mutuality. Then Haydn's rule of interpretation. Sometimes some amendments are brought. For example, section 11 amendment, charitable trust. Any loan taken after 1/4/21 only within 5 years repaid is application. Otherwise, no application. Here, I have taken in 2019-18. You brought the amendment in 21. I repaid in 23. How do you say that it is invalid because loan is before? Court said it is not possible. Within 5 years application. No, earlier amendment 6 years. Now you have suddenly brought this in 2023. The amendment that within 5 years only the accumulation shall be applied. Earlier 6 years was there. So for me, 6th year, even in 24, you should allow me 6th year. Look at the number of interpretations under the Income Tax Act. This principle. Then rule of consistency. If two sisters got the same plot, 50% eastern side, elder sister, western side, younger sister, father gave. The two sisters want to make money. Independently selling half is not correct. They jointly gave for development. So the developer developed, say, 10 apartments, 5 to the 2 girls. So not girl, married. So 2 persons, 2 got the notices. Hey, capital gain, this, that, notice. One sister, both the sisters filed the returns, response notices saying, I converted the land into stock in trade. In the year of sale only it is liable, not based on the development agreement capital gains. For one sister accepted conversion stock in trade. For another sister, no. The courts say rule of consistency. For first one, if you say stock in trade, second one also you should say, maybe different officers. Rule of consistency. One rule should apply in the same facts and circumstances. In the early year you accepted, second year you cannot change. If the same facts and circumstances are there, the rule of consistency in different cases, different examples. I gave the case law. There is a real income theory. I told you. In fact, a live case from here, 1 furlong distance. One fellow of this conscience, real estate business, chits business, money lending business, no books of accounts. Every year filing the return as if he is a very normal man. As people have come to know, he is such a big man, he is deciding who should be the MLA of this constituency. So they 132. What they found? Heap of information. For the 6 years, number of money lending, borrowing, cheats, this, that, so much. Then what they can do? As I told you, net worth theory, real income theory. Even if the income tax officer appoints you as a 142(2)A special auditor, based on information, you cannot write the books of accounts, arrive the correct income for each year. That's why block assessment, 60%, 40%, now 132. So the real income theory, where applies, how it applies, one should know number of different circumstances. Then there comes percentage on income theory, I have already explained you. Then no income can be taxed principle, that's another principle. Human probability, that Sumati Dayal case, during demonetization throughout India they applied Sumati Dayal. One lady got a jackpot race ticket in all the races in 1 year in those days. Supreme Court said, you produced the jackpot ticket, you got to check only the money. Is it humanly possible for a lady to go to all the races in 1 year? Bangalore race this Sunday, next Sunday Chennai race, next Sunday Bombay race, next Sunday Calcutta race. In all the races, jackpot ticket only. Topmost, highest price ticket. Is it humanly possible? Supreme Court, we don't believe. Based on human. So our document is there, evidence is there, bank transaction, race course certificate is there. That is all document built up, we know. Supreme Court said human probability will decide the real income. So we should, where human probability in our assessee's favor you can interpret. Number of decisions. So the commercial expediency. It's also number of decisions, commercial expediency. So based on the necessity of the business, I incur the expenditure, not necessarily wholly and exclusively 37. And lastly, doctrine of impossibility. There are number of circumstances, the doctrine of impossibility. That's what just a few minutes back I told you, 153.3, doctrine of impossibility. So the officer cannot do the assessment, act to tied up his hands, give the refund, doctrine of impossibility. So for each of this, I gave 2-3 slides, 2-3 decisions. So around 50 decisions I have given, like this. Peak rate theory, number of 2025, it is there for the past 30-40 years. For your sake, I have given latest decisions. So peak rate theory I have given, telescoping theory I have given, how it explains in 3 different ways. Then the telescoping theory latest editions I have given. Then I have given the removal of difficulty theory. Like this, what the 12 principles I have said, I have given with practical realistic decided cases, not mere hearsay. So the principle of mutuality, how extensively it can apply to professional associations also, trade associations also. How many of you are aware that 2017 ICAI's return of income is taken up for scrutiny, denied the exemption? Delhi High Court matter. Institute is a commercial institute. It is getting every year profit. Levy the tax. ICAI, constituted by Act of Parliament. The department levied the tax. The institute has to go to Delhi High Court, got the exemption. Hurry, yaar, your interpretation is wrong. Ultimately, ICAI has won. So, we should be, what is a professional association? They call it a professional association. You are collecting money from the members. So, that's how Haydn's rule of interpretation. I gave you the examples. And then, I gave rule of consistency. I gave you the 2 sisters, or say wealth tax cases, so many cases, how to interpret this line. Rule of consistency, I gave the case laws. And income, real income theory I have given already. So percentage of income. So different, I gave few examples. For every business there will be some percentage. Search. You have the time. Sometimes whether you believe it or not. It takes 6 hours for me to get one decision. I go on searching. Number of decisions. Read. Oh, this is not 100% equal to my case. Then what is nearer to me? Or search. Sometimes 3 hours, 4 hours, 6 hours search. One case we will get. Like that, lot of reading we should do. Then only we will get the correct case to help the assessor. So this is the number of percentages for which business. How I gave that Balaji Transport Hyderabad. Say, around 2%, 3%. But it should be, so you must be capable of establishing. So the percentage of income theory, penalty can be there. You may escape percentage of theory income, but the same money you used for some other thing, penalty can also, possibility is there. So no income tax price 3 I have given, human probability I have given, number of decisions I have given, that is something the jackpot case I have given. So then doctrine of impossibility I have given. So with this I conclude, because at the beginning starting some 10-15 minutes delay is there, now 12:10. Exactly the 2 hours time given, I planned, I executed. I thank all of you for giving me this opportunity.
All of you will agree that this was a very in-depth, exhaustive analysis with practical wisdom, and the way he interacted with the audience. We wanted the session to continue further, but due to time constraint, he also has limits. But this is for me also, it's the first experience of such an in-depth analysis and giving us so many ideas to work upon. He definitely deserves a thunderous applause.
Thank you. Thank you, sir.
Thank you. Next session. Before we start this next session, I would request Mr. C.A. SAMSUTHEEN to please come on the dais. Yeah, he's from Trivandrum. Mr. SAMSUTHEEN, he is an M.Com FCA. He did his M.Com from Madurai Kamaraj University, and then in his articleship in Sankar and Murthy Chartered Accountants, he passed in May 1990, then became a paid CA in the same firm. Then afterwards he was made a partner in the same firm, and he became a fellow in 1995. And after 19 years as partner in Sankar and Murthy, he started his own firm, SAMSUTHEEN & Co. in Trivandrum. He's got a lot of varied work experience as Central Statutory Auditor for State Bank of Travancore, Syndicate Bank, Corporation Bank, and other branch audit of various PSBs like BAIL, FACT, KSFE, LIC Divisional Office, Kerala Tourism Development Corporation, Kerala Police Housing Construction Corporation, and Food Corporation of India. In private sector also, he has a lot of audit experience, like Olam Exports India Private Limited. Now it is presently called Olam Food Ingredients. Then he was retained as tax consultant for all the corporates in the Olam group. He has been a faculty in the Institute of Management in Government in 1990s. He was faculty in Institute Cooperative Auditors Trivandrum in late 1990s. He has presented a lot of papers on transfer pricing of international transactions in Trivandrum branch of ICAI. On Bank branch audit paper presented also, and his talk on profits and gains of business profession in SIRC Chennai was there in March 2025. Yeah. The floor is all yours, sir. Before that, I would like to invite Dr. C.A. PHALGUNA Kumar to present a memento to the learned speaker.
For the past 15 years, Trivandrum branch, most of the times, not less than 10 times I have gone. They invite me. Many of you know that the services speakers doing is a no monetary consideration. So, for me to go to Trivandrum and come back, flight tickets, room, local car, Ananta Padmanabha Swami Darshan they will provide. Minimum it costs 50,000 rupees for my 3 hours lecture. Again and again and again and again Trivandrum branch invites me. So we get the satisfaction, we had the darshan. So that's how the speaker's contribution from all the audience, what we expect, your blessings, your good wishes. That's only the thing we feel in God's ledger. Your wishes will be my credit balance. So such a good person. So with all appreciation for his services, I leave. Thank you.
My dear fellow members, first I am thankful to the office bearers and organizing team of the SARC of ICAI for having invited me to deliver a live topic on return of income filing and the advance tax, both under old act as well as new act of income tax. I am very much happy, and I could be a very, very attending student as far as the eminent speaker, PHALGUNA Kumar sir. Before him, I could see is something which is the God poured on me, the glimpses. As far as the topic is concerned, the return filing, it is time of the day, need of the day. And I would like to first focus what is new in this year while comparing to last year as far as return of income filing is concerned, the due date, and some extra information in the new legislation of 2026 is concerned. First, the very focus on return filing time is concerned as far as business classes. For small business below audit limit, the time is extended from July to August. That is a very major amendment brought in this Finance Act 2026. So even for filing of return in ITR 4, time is extended up to August. Earlier it was July. That was one major change. And as far as ITR filing of ITRU is concerned, lot of relaxation is felt. One is, see, earlier when you file loss return, you cannot take further again through ITRU route. Now that is also possible. Only thing is, loss should be reduced than what was declared earlier. That is one major requirement. And another thing, even in respect of SECs to whom reassessment notice were issued, it is a very major change. You can opt through filing of ITRU, which is very, very major step. Of course, because penalty is very heavy, 270A penalty or something is minimum 100% is automatically comes once it is assessed. Now it is only 20, 25, 50, 60, 70. Once you come under that particular route, if it is reassessment taking place beyond 4 years or third year, then 70% plus 10%. You know, of course, interest and late fees, not late fee, interest is automatic, but that is a major change because this reassessment is something like assessing officer issues notices with some concrete evidences, because now 148A notice and receiving objections from the assessee and detailed consideration, finally issue order under section 148A. Only thereafter they issue notice to file your return, and therefore many times they don't withdraw. And once they didn't withdraw and start filing returns, finally assessment takes place, penalty is automatic. Penalty comes. So this ITRU filing return is something narrowing down the penalty requirement. And with that pre-note on return filing, coming to the topic proper. As far as ITR filing is concerned, ITR 1 and 4 are most popular, and mostly small practitioners are helping assessees to file their return in time. As per the recent statistics, detailed statistics which I understood, 46% of the total number of assessees returns filed is ITR 1. 26% of the total returns filed is ITR 4, Sagaj and Sugam. You know. So about 72% of the returns are simplified, relatively smaller returns. Out of which this 46% returns, ITR 1, is generally because of the very return represent assessees who is having salary income. Normally, salary income is not liable for much refund, because salary is, if it is taken for tax reduction, full tax is deducted. So, nowadays, because of this new tax regime, many bank borrowers, house loan borrowers are not claiming this interest on loan and the EMI deduction through ATC and Section 22 claim, because new tax regime is most popular and most beneficial. And now this, because of this 12 lakh regime, 60,000 tax rebate, 98% of the cases must follow this new route because of 60,000 tax rebate and lower tax rate, because old tax regime, the even what is called tax rebate sum is not increased. It is only 12,500 now. Base exemption limit is 4 lakh. So basically only 5,000 comes. Even though law is not changed, that 12,500 will not come at all. Only 5,000 will come. Now, after that rate is 20. So new tax regime is almost coming to an end from this financial year, or at least in the next financial year, because of this major galloping jump. But tax filing requirement is, if you have taxable income of 4 lakh and more, then you have to file return. You can claim tax rebate under section 87A, maximum 60,000. So I believe, based on the statistics, I believe 70% of the return filers will not pay any further tax, and the return filing is something, one extra function, that's all. Because statistics up to 10 lakh income categories are very significant as per last year's statistics, which the return filing is something superfluous function as far as present rebate limit is concerned. With this, I try to further elaborate what is form number 1 and who are all eligible, who are all not eligible under form number 1. Form number 1, basically the assessee should have income from salary or pension, or income from other sources like bank interest or institutional interest. This time in the form there is one additional column called in others, interest received from NBFCs, housing finance companies. Separate column is given, and therefore we should mention that as a separate line item in the ITR return. Nothing what is called the additional tax implication, but you cannot just avoid. Then this time one more little relaxation is given for property owners. Property owners who have 2 property from where rent is received, also given the chance of filing return through ITR 1. Up to 2 houses you can. Up to 2 houses is started applicable only from the assessment year 26-27 as far as filing through ITR 1 is concerned. Earlier only 1 house was allowed. And this year another important relaxation is also given, where long-term capital gains up to 1,25,000, long-term capital gains up to 1,25,000 can also be declared through ITR 1. Up to 1,25,000 exemption is available. It is not taxable at all. But earlier, if you have taxable capital gain, even exemption was available, you cannot file it through, because the exemption you have to disclose the income and claim exemption. You cannot totally keep outside the income tax return, and therefore taxable capital gain you have to disclose. Once you disclose, then earlier route was only ITR 2. Now ITR 1 is allowing up to 1,25,000 and claim exemption.
Sir, I think it was there in last year's return form also. ITR 1, last year's return form also allowed up to 1.25 lakhs.
Okay, but this year it was being highlighted. Okay. Then ITR 1 is available only for those whose income is up to 5 lakh. Then ITR 1 is not applicable for directors in a private limited company. And it is not applicable for shareholder in an unlisted private company, unlisted company. It is like last year only, but it is noticeable because small people, people who have very small company, private limited companies, because from last 10 years, private limited companies are being floated for normal business farmers, and they are not eligible, even if that is a very small business organization. The shareholder cannot file through ITR 1. And those who are having TDS under section 194N, cash withdrawals from bank beyond certain limit, 20 lakhs, if you are drawing more than 20 lakhs, then you are covered under 194N. Then once you are covered under 194N, you are not eligible to file ITR 1, because ITR 1 is a very small one, therefore many people try. But once 194N is there, then you cannot file ITR 1. Then those persons who are eligible to, who are liable to file ITR 1 or ITR is people who have foreign travel expenditure of 2 lakh or more, people whose electricity consumption expenditure of 1 lakh or more, and people who have bank deposits of 50 lakh or more in their SB accounts. Those whose bank account shows 50 lakh or more, even though they don't have any taxable income, they are liable to file ITR, and they can take ITR 1 also. There is no problem. Likewise, say if people have turnover of 60 lakhs or more, they liable to file ITR, even though they don't have any taxable income. Likewise, TDS. See, if you have TDS, tax reduction at source, in respect of bank interest or dividend income or what is called mutual fund income, and your total TDS in that financial year is 25,000 and more, you are liable to file ITR. So that particular requirement is also there, even though your taxable income limit is less than the exemption limit. But you are eligible for refund. You cannot keep away from tax return filing. So these are all the broad eligibility and requirement as far as form number 1 is concerned, which is relatively very low. And non-residents also not eligible to file ITR 1. It is available only for residents. And as far as ITR 4 is concerned, ITR 4, that is also Sugam return, is concerned, all these conditions again applicable, because that is also can be filed only by residents, and the base information as far as ITR 4 is concerned largely emanates from GST returns. Turnover is a criteria, because it is a business return liable to be filed within 31st August. ITR 1 is liable to be filed within July. So from the GST return, you have to take the turnover, and you have to declare the turnover as well as the percentage of profit, expected profit as per the section 44 AD, AE, etc. So 44 AD says if your turnover is realized in the form of bank receipts through bank directly, not cash deposit, through bank, then 6% of such turnover is your profit. Anything other than direct entry to the bank is liable for 8%. So now 12 lakh is a limit based on which we need not pay any tax. So 12 lakhs means if it is purely 6% income is calculated, and presume hypothetically they don't have any other income, up to 2 crore turnover, you don't have to pay any tax. But that is only hypothetical. Both cash, because UPI and other phone pay related realization for small traders is nowadays very common, especially in cities. So even 50-60% of any small established dealers, traders, retail outlets, 60% bank, through bank, and 40% cash. Then also the declaration may not result in much tax payment. Declaration is relatively easy because normally anything more than 40 lakhs, turnover more than 40 lakhs, there will be GST registration, because nowadays GST registration limit is 40 lakhs for businessman. Even now 20 lakhs for professionals. So there will be GST registration for taxpayers, and based on that turnover is to be taken. For businessman 6%, 8% rule. For professionals 50%. 50% the minimum income which should be declared. So even with 24 lakhs gross receipts, you need not pay any tax. Of course, if TDS is there, you are eligible for refund. It is relatively very easy nowadays because scrutiny is very, very rare as far as non-business returns are concerned. Unless some corroborative information is available in AAS and 26AS database, which is ignored or which is not matching, then because nowadays from last year onwards, this matching with section is section under which tax was deducted is being cross-checked. But the scrutiny notices so far has not come. Scrutiny notices may come in future. And there the question of 194C, 194J, these issues will come. It will not simply match, but at the same time issues may come in future, and therefore while verifying professionals receiving what is called receipts, whether it should be classified as business turnover or what is called professional turnover for the purpose of 44 AD, we should decide based on the section. But if it is inadvertent error by the tax reductor, we need not bother. We can go ahead with accurate section about the accurate information. So ITR 1 and ITR 4 comprises about 72% of the return filing work, which next 2 months small practitioners will be mostly engaged with. It is more of workshop related training, action related matter. There is no detailed guidance or learning potential from academic side is required. Practical side, when you enter, why you could not be entered, whether it is matching, etc., is sensitively to be seen. Especially for large cases, it is better. And those people whose assets outside the business balance sheet exceeds 1 crore, then they should file assets and liability statement that started from last year onwards. Before that, the limit was 50 lakh. Those whose assets outside the balance sheet, especially personal assets, say there will be buildings, there will be the jewelry, there will be vehicles, personal vehicles, not assets recorded in the balance sheet. If it exceeds, the purpose of those collecting those information is there should not be disproportionate income. Pardon? Admitted income should be within that particular assets declared outside the balance sheet. Otherwise, there may be scrutiny, but so far such analysis did not take place in the last 10 years, for your information. Therefore, information giving is not a very, very risky matter as far as income tax returns are concerned. So, information we should freely start giving so that it will help you at a later point of time, at the time of selling the house or at the time of selling the jewelry, whether you declared, if your income is more than 50 lakh only, it comes. But if that is declared in the asset and liability list, it will be easy to reduce cost of acquisition or cost of improvement. So, those things also should be kept in mind while preparing ITR 2 and other returns. 1 and 2, 50 lakhs and more assets and liability list cannot be declared. And as far as ITR 2 is concerned, it is relatively lengthy. 2 is returns to be filed by a person who doesn't have business income, who can have any other income. But if he have business or professional income, then he is not eligible to file ITR 2. ITR 2 return filing due date is 31st July. So, now the due date you should understand for business class August. Business class with audit, return filing is October and audit report filing is September. And business class with transfer pricing audit, additional audit for international transactions as well as specified domestic transactions where transfer pricing audit is required, then it is November, 1 month extended. This is the broad parameter. So, business 3. One is exceptional, special audit under transfer pricing is something exceptional. So, normal business audited, unaudited. Unaudited 31st August. Audited 31st October. Audit report should be filed 1 month before return filing. Audit report filing is mandatory field to be filled in while filing the return, because without that it will not validate. Therefore, audit report file, and from last 2 years, many of the what is called delayed filers are getting 271B notices in respect of delayed filing of audit reports, in respect of what is called scrutiny cases. In respect of scrutiny cases, now 271B is a normal notice. Earlier, 271B notices were exceptional. Now, they started issuing notices. And at least from last 4 or 5 years, we can understand, except technical glitches, for no other reasons, extension is given. So, extension we cannot, we need not expect or predict. Extension of filing time, filing for time is not generally being given. Except some technical glitches, for that also they are giving maximum 7 days, you know. And because of intervention by the court, last year some extension is given. Otherwise, government is not willing to give any extension. That is rule, and extension given is the only exception. Now, as far as farm number 3, for businessman, farm number 3, both for unaudited as well as audited. Both for unaudited as well as audited, because even for unaudited cases, people file farm number 3. Where for unaudited, August 31st, and for audited with audit report within October, and with a special audit under transfer pricing, audit return is due to be filed within November. See, 3 is also relatively larger number. As far as small practitioners are concerned, 3 is a very big matter. 3 requires a profit and loss account and balance sheet. 3 requires audit report in select cases. And 3 preparation is something, what is called the housework is enough there. It is not just filling the returns and filing. 3 requires some sort of preparation of profit and loss account and balance sheet, and in audit cases, preparation of audit report with balance sheet, profit and loss account. Even now, audit report filing, it is not XML file. It is just filing of your papers. In Companies Act, MCA filing, now XML file started at least from last 4 years onwards. But here it is a separate file with some papers, ITR and balance sheet. And therefore, many of our balance sheets doesn't contain all the information as required in ITR 3 or ITR 5 or ITR 6. ITR 6 is many times extra information than what was available in our audited balance sheet. To avoid this particular phenomena, from last year onwards, for non-corporate entities, format is prescribed as a guidance. Even now it is only a guidance, but predominantly it is being followed. That contains most of the information as required. Many, because based on experience, I understand from what is called the information generated from income tax side, the audit report filers are giving only balance sheet and profit and loss account without schedules. Most what is called the information available in 3CB with the balance sheet is only 2 sheets. Even though even if schedule number is given in that particular sheet, schedule is not attached. And notes forming part of accounts is not at all being attached. So this is very, very important. Notes we should attach, because notes are forming part of accounts, especially ITR 3 with the balance sheet. So even if it is 10 sheets, what is the matter? Because even now it is not XML, and therefore department is not going to process through that particular route. If that is done, we should be more sensitive, because ITR and audit report are one and same. Now also it is one and same, but at the same time, many particulars available in required in ITR 3 or ITR 5 or ITR 6 is not available in line items of the balance sheet or schedule. Sometimes it may be available in the notes, but these should be linked wherever possible. As far as possible, it should be linked, because ITR and balance sheet is nothing but different. It is not a different document. As far as ITR 3 or ITR 6, ITR 5 and the balance sheet profit loss account, is it different? Let's be interactive. Whether ITR 3 and the balance sheet of the firm, balance sheet of the individual, is different. We call it as ITR 3. It is nothing but balance sheet, because basically he is a businessman. We are giving what is called assets and liabilities, that is sources of funds and application of funds information in the liability side and asset side of the ITR format is nothing but balance sheet. What else they are giving by accepting the personal profile, and therefore, as far as possible, we should meet the requirements of guidance note in non-corporate entities balance sheet, and should be linked with ITR 3, ITR 5 and ITR 5, because ITR 6 already format is there. So, this will reduce your time in filling ITR from the audited balance sheet. And additional requirements as far as balance sheet preparation or profit and loss account disclosure requirement in ITR is concerned, nothing new. Nothing new. It is based on accounts. We should prepare balance sheet in accordance with the accounting standards and disclose all the material information based on disclosure note required under guidance note. At present, for non-corporate entities, guidance note is guiding. Guidance note is based on accounting standards only, but there is a format which we should follow. Many of us were not following earlier, because no balance sheet is giving up to last year figures for the previous year. Now from last year onwards, we started giving. And as far as form number 5 is concerned, it is very minimum only, because partnership firms now, youngsters are floating companies only. Partnerships, we follow the format only for family company, family business organizations and inherited organizations, partnership follow. Otherwise, we now started moving private limited company formats and where format is very much available. And therefore, a lot of benefits are available under private company taxation also, because now tax rate is 22% plus 10% surcharge plus cess, say 25% is the rate. But here in firms, we have to pay 31.2%. 30% plus cess, 31.2%, no exception. Now, partner salary and partner's interest, there is a cross-checking through TDS route under section 194T. 194T is now mandatory. Now you have to deduct tax at source at 10% in respect of interest paid to partners and salary paid to partners. In respect of salary, many times we fix based on certain percentage of profit. But how can we fix TDS within 31st May? That there is little difficulties there, and many people may file the TDS return in respect of TDS on partnership salary after 31st May because of this reason. Because many of us only for reducing the tax liability for the partners and firm, this salary concept itself came into the statute book. But that cannot be strictly implemented because of this TDS route from last year. So that, but it is not avoidable. It is not avoidable, because once the TDS is not deducted, the very salary and interest is not eligible expense. It cannot be reduced from. It cannot be reduced from taxable income. That's a very, very serious thing, and therefore that you should follow. Then third thing, if you are in a private limited company, payment made to specified person in the audit report under section 40A7 is a statutory disclosure requirement, but that will not make you any assessment simply. And therefore, you need not restrict your distribution to partners to the extent of limited to the extent of limits specified in 40B of the Act to specify for first 60 lakhs, first 6 lakhs 90%, balance 60%. That particular restriction is not there in respect of companies, and therefore, in respect of private limited companies, you can pay any amount of salary which you want so that you can reduce the tax, because 12 lakhs is the limit. In a private limited company, normally 2 or 3 people will be there. Their working partner and other status is not strictly there. You can pay salary. Here, working partner, you should write down and you should continue with that. That particular track is being maintained through partnership deed. In respect of company, that particular legal requirement filing is not there. Even though service agreement, everything is there, it need not be put in writing. It need not be filed to anybody. For payment of to a director, I need not file to anybody. For payment of salary to a director, I need not file to anybody. And therefore, I can decide in a private company. 47 disclosure, you should make it. But disclosure, I can make it because for small companies, what issues going to come? 12 lakh limit is available for tax exemption. But that particular 12 lakh limit is not available in respect of partnership firms. And therefore, those who are auditors of partnership firms can rethink whether that particular status is really required or company format is more beneficial. Because company, one additional requirement is there, MCA filing. MCA filing is not very difficult nowadays. It is not very difficult. But that is an additional requirement. That's all. But compared to the tax advantage, this is far, far better. Because company, the very tax rate itself is 25%. Here, profit-based restriction is there in respect of salary to partners. So, those restrictions are not strictly there in company. 48 disclosure is there. That is only a disclosure. Here, it is a statutory restriction. The disclosure and restriction should be differentiated. Therefore, private limited company format would be more advisable in respect of partners. As far as company return form number 6 is concerned, is very, very elaborative, and there is additional requirement in respect of Ind AS disclosures, which is available last year itself. And company, what is called the audited financial statements in Schedule 2 and the appendix can directly be fit in what is called the ITR 6 requirements also. Most of the requirements are already available in our Companies Act requirements itself, and therefore, but the information is very exhaustive and very elaborate. Therefore, new what is called return filers for companies, you should fully read the ITR 6 at least thrice, according to the suggestion of PHALGUNA sir. Minimum I should read thrice, then only you know what are all the information which can be already made available in audited financial statements. Audited financial statements, because it should be ditto only, because there also, what is the difference between ITR 6 and company audited balance sheet? Company audited balance sheet is ITR 6. What else? No. But at the same time, if you look at information sheets available in ITR 6 is very, very lengthy. Of course, certain information need not be relevant in a particular case, but at the same time, it is very, very lengthy. And therefore, those readings are inevitable to fill those readings were inevitable while doing the audit and preparing the financial statements of companies, private companies especially. Large part of us are engaged in small private companies where this particular information filling is something very, very essential. And this transfer pricing auditing also only for international transactions where associated enterprises are in our what is called supplier base or in customer base. If associated enterprises there, this TP audit is essential. And now the differences between arm's length price and the transaction price, lot of relaxation is given, and this TP audit guidelines are highly comprehensive, highly now voluminous, and therefore reading is essential for those who are engaged in transfer pricing audit. Transfer pricing audit is a very, very lucrative what is called audit requirement, which is something specialized, which is lucrative also, because exporters and other large international organizations pays enough fees if you can clearly interpret and tell the requirements of the law, because it will be tested at the other end also. They will verify, and finally with their auditor they will support or they will rule out. But it involves some what is called application of professional expertise, for which they will reward you, because you only find out this particular issue, which is necessarily to be taken through TP documentation, and therefore it is good. Sometimes they say this particular issue is already taken care at the other end, and therefore we need not specifically consider this particular issue at local level. So those things also to be considered. Now I would like to interact with my dear members in person, at least for next 10-15 minutes, regarding income tax return filing of ITR 1, 4 first, and 2, 3, 5 and 6 next, at least for next 10 minutes, so that let's interact, because now for the last 30-40 minutes I was talking, and this is a routine thing, and therefore many people feel it is superfluous only, but at the same time I am just refreshing, and I can also understand based on your queries better. So I would like to expect some queries. Any issues in ITR 1 filing requirement? Let me see whether anybody has question whether this particular person is eligible, or if there is a dilemma in filing ITR 1. Please. ITR 1 filing or ITR 4 filing. 4 is meant for business classes, small traders, small companies. Company means other than companies.
Hello, in case of ITR 1, you said that if you have shares of a private company, you should not use it, or
yes,
only if there is a dividend from there, we need not use it. How does it work?
No, if you are a shareholder, you cannot, because law says if you are a shareholder in a private company, you are not entitled for filing under 1. It is not based on dividend. But you can have any quantum of share in a public limited company, in Reliance or Infosys or TCS, you can have. You can file ITR 1. But if you have a company with 1 lakh capital, with a small business of say 1 crore turnover, nothing to it. You cannot file. 194T.
At the same time, as per the limit specified in
20,000.
Yes, sir. So then if they disallow on the basis of partner salary in the firm, But as per 194T, we have to show the gross income only.
No other way.
No,
Because law says that partner is entitled as per the partnership deed. Therefore, I will assess a partner,
okay.
irrespective of whether it is being allowed
Allowed or not.
under firm's assessment.
Before that, no TDS means we can manage in the.
We can manage. Now
Now
we cannot
it is not
manage.
possible.
And that too, see, 200 rupees per day for a small man for delay in filing. Is it affordable? 200 rupees per day. See, if 1 month the delay just goes 6,000 rupees. The very TDS may be 6,500 rupees.
Yes.
No. Delay in filing of TDS return is up to 100% of TDS amount. Even for our own fees cases, sometimes we missed it. At the time of filing return only we found. No, but how much? It is 6,000 rupees. Delay? Sir, it is 2 months delay, sir. Okay, you need not claim. You need not claim. But the problem is, other person had to pay tax in respect of expenses. Because it is not allowable for him.
So no other way we have to.
No other way, because salary we cannot avoid, because firm is subject to 30% tax without any exemption limit. Where partner share is restricted like this, only 3 lakh rupees maximum salary without tax. So 3 lakh. If I am in a company, minimum 24 lakhs I can take away as my salary. Who else is coming? Because minimum 2 person is there in a partnership. No, minimum 2 partner. Either husband, wife, 2 person is there. No. So such a vast difference is there. And, of course, you can claim refund in your personal partner's return. It takes a little time, Refund you are eligible. There is no problem. Now that's what is called lowering TDS rates. What is called the format is very, very broadened and is easy also. People can try, so that since a partner is not having any taxable income, you can claim through lowering route. Lowering route is now available for almost all the what is called TDS items. Yes. For companies, you please ask, because a lot of issues may be there.
No.
In format filling.
In this partnership, people tend to change the remuneration.
Please louder.
Normally in partnerships, people tend to change the remuneration as suitable for them at the end of the year. Okay. But what the deed says is, on the first 6 lakhs of the book profit, so much percentage. On the balance, so much percentage. And there is an overriding rider which says that the partners may, at their option, take a lesser salary as agreed to between them year after year. If that clause is there, can we change the remuneration every year?
But according to the law, according to section 40B, you should prescribe the salary. That is why minimum clause, that is why there should be a minimum remuneration, there should be a maximum remuneration. Even though you fix based on your profit, there should be minimum remuneration, or there should be maximum remuneration. Therefore, if you are giving a subclause, giving option to reduce, how can you reduce beyond the minimum fixed? If you interpret in such a way that is also possible, then what is fixed? Remuneration should be fixed. Sir, you please enlighten, sir. You please enlighten, because his query is valid. Why I should not reduce? I don't have profit. Should I not reduce my partner's salary in my
Or
books?
do we have to prepare codicil every year? To the
Why not?
partnership deed?
There is no prohibition. You can change every year. There is no prohibition.
No. You cannot anticipate what will be your profit year. So because the Act says that it has to be done before the commencement of the financial year.
Yes. But there should not be retrospective. See, instrument in writing, it need not be registered. See, you buy the required stamp paper and decide at the time of preparing profit and loss account. You see, if you feel that this a good firm will have some profit, therefore you buy a what is called stamp paper, keep it with you, and
As and when necessary, we use
decide at the time of preparing profit and loss account. So
Yeah.
that it costs say 1,000 rupees,
Yeah.
So that kind of planning is advisable because
Off the
partnership tax is very costlier. It is unaffordable
Off the
for
record.
larger. Huh?
Now, TDS is liable to be deducted on the partner's remuneration
Huh.
at the time of credit or payment.
So instead of giving monthly or something, we can plan such a way that we pay the salary annual at the in the month of March, so that you have ample time for planning how much has to be given and all that.
This is practical only when there is an accountant. No, nowadays after this the digital era comes and computerization comes, many people don't have accountants. So chartered accountant may not prepare profit loss account on every month or every quarter. That is a real issue. See, for 3 crore turnover or 5 crore turnover cases, there may not be regular accountants. If at all accountants are there, they may have given outsourced people. And outsourced people, they concentrate only on GST filing. So base information take from 2B or 2A, and finally, if sales data is given, with that they will proceed. They are not concerned on expense accounting. And this owner is not at all looking at this particular outsourced accounts. And therefore, practically it doesn't happen, especially in our places. I don't know how it takes place. If somebody can highlight the practical scenario here. See, these drawings every month is also not based on your profit, based on your requirements you are drawing, or based on some what is called audit suggestion or auditor suggestion, you are putting drawings amount. See, drawings amount, many times drawings amount may not be known to the taxpayer. See, drawings amount may not be known to the taxpayer, and therefore it doesn't have direct connection with the real profit or real distribution, because you can draw more also. Drawings is not your salary. Drawings, I need not account it as salary. TDS should be deducted. TDS should be deducted at the time of making entry in the books of account in the form of interest or salary. Interest, whenever you are monthly paying, you cannot interpret differently. Drawings, you can interpret differently. Drawings, it is my firm. I can draw more, I can draw less. 31st March. 90% of profit firms are small firms, and therefore entry only auditor makes at the time of finalizing the accounts. At that time is little late from the due date for filing Q4 TDS return. No.
Anyway, we get time for filing TDS return also, because year closes at 31st March. You on the last day you give a credit for the salary,
And
then you
therefore,
got time till 31st May to file the TDS return.
that is a correct advice. Say you have within a week time means late filing also. The payment you account as drawings,
See,
sir, because it is TDS.
No,
TDS payment.
if you're paying well and good, if you're not paying, you give a credit to the account on 31st March. So TDS is liable to deduct it at the time of giving
TDS
credit
payment,
or
sir.
payment.
Sir, delayed payment involves interest.
Next financial year you can
Interest
pay.
is very minimum. See, this late filing fee is very heavy. Interest is minimum, sir. But interest you have to pay. Interest is not big, but this because late fee
200
is
rupees
very
per
heavy.
day. Late filing fee. 200 rupees per day, I think.
200 rupees per day.
Yeah. TDS late filing.
That is a real worry for small people. That's why because of this salary restriction, because of this higher tax, because of this partnership TDS now is giving something higher regulatory cost. You know, why I should not go for a company in such cases? At least my what is called nomination and inheritance is positively available through nomination entry in the shareholding application itself. But in partnership, this nomination right is not available.
Nowadays, a lot of people opt for LLPs also.
LLPs in Kerala, our people didn't experience much, but LLPs are mostly practiced holding company, subsidiary company. In those atmosphere, by the large corporates, LLPs are being applied. And in respect of professionals, they are applying because most of the professionals are not family people because they have organization of different, what is called, sometimes nowadays it is a different age class also and different locations also. Therefore, LLP is better because everyone's liability is determined in the instrument of partnership. So, professionals are following and business group in all India level also it is not being practiced. I don't know. LLP form number 1 minute. Form number 5 only. 5. Form number 5. Because there the fourth digit in the PAN number itself is F only. It is not C. For companies it is C. Please help him.
Yeah, I have a query regarding ITRU. Can you help me on that?
Pardon, ITRU?
Yeah. It's a practical problem I'm posing. If you can, you can. Otherwise,
No, you please tell me so that I can understand and try.
Yeah, if you recall, up to assessment year 24-25, if there was a mismatch in 26 AS between the return and the 26 AS, we normally used to get a 143.1 no communication, and we used to either defend or accept the deviation and close the matter, right? But now what is happening with this ITRU having been introduced, in the case of one of my clients, on the 15th or 16th of March 2026, okay, for the financial year 24-25, he gets a notice from the risk management section saying that
RMS.
Saying that there's a huge mismatch between 26 AS and your return. Please do not treat this as a communication under any section. Please take necessary action for updating the return. Unfortunately, the client also did not forward the mail to me. I came to know much later in the month of April or May about this communication. Now when I... Okay, as it is beyond the due date. Okay, now the system is not allowing me to ask for a rectification return. It says I have to file an updated return, ITRU. The problem with ITRU is because in the return the TDS claim was higher, and I have to now reduce the TDS in the return. It is treating it as income that has escaped, despite the refund being lowered. it is treating it as an income and it is charging tax and penalty, whatnot on that amount. So is there a way out of this, to escape this ITRU? Because it is not allowing me to file a rectification order also for this.
ITRU, there is no revision
No.
also.
I'm saying if I opt for ITRU, the client is under a huge liability. Because the system is calculating the amount, higher amount claimed. On that, it is claiming interest, penalty, and late fee and everything. Now, this is a way of, it's a very draconian.
No,
way. In the normal course, 143(1) May, it should have got settled.
See, whether you are telling your practical case. See, in small cases, when the bank loans, I will come to your topic also. I will just narrate in another situation. See, for small cases, for bank home loan borrowers, they want to file 2 years or 3 years return. Sometimes, in some cases, what's called beyond 1 year. Beyond 1 year means you can opt only through ITRU. No, now beyond 1 year you can opt only through, because return can be filed only within the assessment year. That too only within 31st October up to last year. This year one extension is there, that also I should highlight. See, this year onwards, revised return can be filed till 31st March of the assessment year. So 3 months extension is available. That is a relief, real relief for those people who want to rectify. As far as his question is concerned, whether ITRU is facilitating your issue. So unless the base figure is changed, base figure income figure is changed, you cannot do anything, because portal is calculating. So unless you reduce, in order to avoid additional interest or unaffordable interest, etc., you should reduce income to the extent you can pay. Because a portal is calculating, you cannot calculate. You reduce income so that
was taken
refund is not eligible.
You have taken a tax credit more at the time of filing and claimed a refund. Okay, now you are going to get a lesser refund. Correct. Just leave it. Don't do anything. They will not give you higher refund at all. They will only match it with 26 AS, and if it is there, only then they will give you. Otherwise, they will only give you a reduced figure only. That's it.
No, his fear is the corresponding full income will be taken. See, that is his fear. For that, what I am suggesting is, you reduce the total income in such a way that accurate income, accurate liability, the corresponding income you project, it should not result in any refund. That's all. It should not result in any refund. There should be even the 1,000 rupees tax they will accept. Even 10 rupees with interest also. That's why this base figure, the income which is going to be declared, scrutiny normally will not come, sir. Just like as other, it is not voluntary disclosure scheme, even though it is intended or thought to be so when it was introduced 3 years before. But ITRU is not taken for scrutiny merely because that it is ITRU. ITRU is a facilitative mechanism, especially for youngsters who are home loan borrowers or vehicle loan takers. It is really helpful to them. Oh, that requirement is
It
not
is
there.
done
First time
pre-
also,
first
first time
this
also
earlier.
you can file ITRU.
Are you sure?
Yes, I have done. Updation is only word.
Only thing you have to pay that late fee for 1,000 or 5,000.
Minimum. Because of ITRU, you should pay something now. But if it is within the tax exemption limit, late fee is not there in ITRU. ITRU only interest. Late fee is also there. Late fee is there. Even in respect of cases where tax is not there, late fee is there. I didn't talk about ITR-7. Nobody was what is called hindered. Because that is a large topic. It is not necessary. Is it not? That is a larger and longer topic.
6 hours CPE credit by itself.
Pardon?
Income tax return, there is a separate column. So, while issuing notice and under class and all, it's showing it is adding back second time also by mistake. So, you'll have to file rectification petition under section 153. So, my observation is that there is no separate column in audit report when it compares with ITR return, ITR 6. So, there should be some.
Yes, that particular issue, because there was no separate line item.
Yeah, because you have to show it in personal expenditure or something like that. So, we'll have to explain. And it is a baseless notice it's coming. So, we cannot explain.
We should write to institute to give the format linked with schedule 2. It is relevant and true. Shall I go to advanced tax requirement with the permission of kind members? See, advanced tax, there is no new law. Existing law is reintroduced in the new act. Basic exemption from advanced tax requirement is 10,000 or senior citizen who doesn't have business or profession income. Senior citizen who doesn't have business or profession need not pay tax in advance. Advance tax amount is estimated tax minus TDS is the advance tax amount. Then rate is 15, 30, 30, 25. June 15, calendar quarter middle. June 15, September 15, December 15 and March 15. In March, law permits even tax paid within 31st March is also taken as advance tax. Because any tax paid after 31st March will be taken as self-assessment tax. One of the problem for self-assessment tax is we have to pay interest for the amount already paid in April or May also. Because it is not because our tax calculator is fixed in such a way that any amount paid after 31st March is taken as self-assessment tax. Now, 90% is the amount, minimum amount which is liable to be deposited within 31st March to keep away from interest on delayed payment of advance tax under section 234B. 90% we should pay. So, every year 10% of increase in turnover means if you estimate based on last year income as current income and pay tax, your final liability also will be less than 10% in the norm course. So, current income definition, if at all your assessing officer interpret that this is last year income and therefore on this amount you have to pay tax, we can pay. But if our current income is less than last year's, you need not worry to pay less because there is no income tax provision to invoke to pay this much compulsorily. If you don't pay, there is no penalty for not having paid. Interest is there. Interest under section 234B is there, 234C is there. There is no what is called law to levy penalty in respect of non-payment of advance tax other than interest. Law says current income. Current income you have to calculate. If assessing officer is forcing you to calculate, maximum they will say last year's income is your expected income of this year. So, we conventionally follow last year's income as a current income and go ahead. Normally, no people punished in last 35 years my practice, 36 years my practice life. Because of non-payment of advance tax, nobody punished by levying penalty. Therefore, don't worry. But even there is a calculation error, even if there is, only thing is it reduces the taxpayer's burden. Say 1 lakh altogether once in a year means it is very, very unaffordable to middle class taxpayers. And therefore, you paid 15, paid 30, paid 30, paid 25. Sir, the 25 I couldn't pay. Okay, doesn't matter because that interest, 3% interest will come. 30, this time I couldn't pay 30, you pay 20. How much you can? Sir, like 15 paid in June, can I pay? Oh, I pay. But next time you should pay at least 45. Sir, how? Because you already committed shortfall. Instead of 30, only 15 is paid. So, next installment 45 you have to pay. So, that difficulty for small people cannot digest and therefore, we should follow a system that works. Financial behavior also postulates that particular principle. If it is paid, people start paying. Paying together, sir, they will ask, sir, whether there is any way. What is, no, you are bringing 10,000 rupees interest for 1 lakh payment. How it is? No. So that those things we should avoid. And nowadays tax elan preparation etc. is not a very laborious thing. Therefore, for regular practitioners, you start practicing for making advance tax payments to clients. And 234C inevitable. For 234C, this 90% principle doesn't work. Self-assessed income, you have to pay. So, even for normal cases, 234C always comes. And as far as advance tax is concerned, it is only a procedural one. There is no strict legal law. Only thing is, interest is there. Interest you cannot avoid. And there is no interest waiver also. Under 234C is there. And if it is not paid within the tax year, you have to pay 234B also. 234B is very costlier. And by some chance, if you are delaying filing the return also, there is a compounding penalty which normally people cannot afford. 234A and B goes together. Which is 2% per month means it's a very, very unaffordable penalty. Actually, A is a penalty. Why you are keeping it under? Then now one more section is brought for your information, 234F, and after that, I think I. 234I is brought in respect of filing revised return after 31st December. You should pay late fee. That is also brought it. Just like as ITRU, it comes in another way, and they are encouraging, and there is no difficulty also. Earlier, 10 years before, people fear even to revise a return because scrutiny comes. Nowadays, that fear is not at all there in respect of revised return, in respect of ITRU. ITRU is routine. Government gets some extra tax. If it is older return, they get up to 70%. If it is a return in pursuance of initiation of reassessment notice, that is also permissible. You pay it. So, because additional 10% is also getting. But being away from this, what is called allegation by the assessing officer on the gross figures. When I prepare the computation and file ITRU means I take care of everything. I bring everything on record in a computation format, in ITR format. Assessing officer while making assessment under section 143.3 with reference to 147, he knows only gross figures. I don't have any role till whatever statements which I file it, they will take it, or whatever deductions which I claim during those calls, he interprets. And ITRU means I filed, you based on that you proceed. Normally they don't proceed. So it was file ITRU, it was file extension of what is called revised return even after 31st March. Now for 5 years, not 5 years, for 6 years, you can file the return voluntarily. 4 years ITRU, 1 year up to 31st March extension. So 5 years you can file the return plus tax year. So 5 years you can file the return even without any fear. See, reassessment, there is a very big fear, Reassessment with evidences, they started coming. This we can, if 50% extra can be given, we can mold the data in such a way that we can, we need, and finally we be away from future scrutinies, Therefore, advance tax, it is a financial behavior, it is better, and non-payment of advance tax, and if you are ready to file your return with a definite income, interest is unavoidable. Interest is unavoidable, there is no waiver mechanism. Interest is generally unaffordable, and cumulative payment for middle class taxpayers is not affordable. Therefore, better we should go with the advance tax payment for businessman. Senior citizen not required. Senior citizen advance tax is not required if they don't have business income.
Sir, a senior citizen, a partner in a partnership firm. He is not drawing any salary. There is no, the only thing that he gets is share of profit, which is exempt. He is filing an ITR return, ITR in ITR 3, right? So now, is there a case of what is the correct interpretation, sir? The thing says if the senior citizen does not have any business income, you are not required to pay advance tax. Here in this case, he is a partner in a partnership firm. There is no doubt. He is getting only a share of profit, which is exempt. So, in this case, will there be an interest levy for failure for payment of advance tax?
I personally believe, which is true, which is practical, is he has to file ITR 3 only.
Correct.
Because he has to declare his partnership interest in his return.
Right.
Therefore, that is unavoidable. He doesn't have any taxable income from business or profession, and therefore he need not pay any tax, advance tax.
But unfortunately, the system is programmed in such a way that if you go for ITR 3, even if you don't declare a single income as taxable, and you declare only as
There is
exempt.
no decided cases, and therefore when it calculates, we should not we should validate with that defect. We should upload without paying interest, because I don't have any taxable business income. Therefore, why I should pay? Profit is exempt because ITR 3. That's why ITR 3 I cannot avoid, because statutorily there is a format.
Correct.
And with any information relating to that particular format is available, then I cannot hide it, by filing ITR 2.
Right. And
And there is no decided cases.
and of late, are we seeing a unhealthy trend where are we seeing a kind of an unhealthy trend where there is an increased what shall I say, an increased thing by the department to try and administer the act through the IT return form itself, because for example, there I think many of them, I don't know, last couple of years, some cases there have been instances where after you file the return, there is a kind of a quasi notice / an information alert which is they get saying that according to 26 AS there are certain sections under which tax has been deducted which does not make you eligible to file under this particular IT return form. Therefore, you're required to, there is a this return could be treated as defective. Kindly file under the correct return form. So I mean it's only it's not under
Warning.
any thing and all that.
Cautionary. It is a cautionary note.
It's a cautionary note, sir. So, but here, so
like this NUHG, nudge related information heavily came in March end.
Correct.
And our middle class taxpayers are unnecessarily harassed and after mental agony for about a month. Sir, what we should do? Sir, what we should do? In certain cases, we are very much aware that they are only this much and therefore they need not go for any ITRU. And we suggested. And, thereafter, nothing nudge. In April, nudge is vanishing. So, this kind of threats will be there. But broadly, we should understand that there is a what is called analyzing mechanism that is available. Because of cumulative effort, some empirical data they will take, and finally they will take a decision after 3 years or after 4 years. Those things are unreal. Yeah. Thank you very much for your very, very patient listening and interaction at the time of question and answer session. I thought that most of the relevant information in my mind are shared, and experiences are also being shared whenever questions were brought before me. Thank you very much.
Thank you, CA SAMSUTHEEN ji. We'll break now for lunch, and I think you should all be back by 2:30. And we thank SAMSUTHEEN ji for taking us through the nuances of all the different types of forms and their applicability, and we had good interaction. That was good. Thank you. Welcome, friends, after a sumptuous lunch, and it's an interesting topic after lunch to keep you all awake. We have with us CA Venkataraman, who is a practicing chartered accountant and founding partner of KVK and Associates LLP. He is an alumni of Loyola College, having professional experience of 9+ years in employment and practice. A young CA, he's also got his office very near Loyola College. Also a member of CPE Australia, he is currently specializing in international taxation, corporate compliance and risk consulting. Faculty for CA, CMA courses, and also handles seminars and sessions in various forums. He has received various awards and achievements in both education as well as profession. Please welcome CA K. Venkataraman to the dais. I would request CA SAMSUTHEEN to kindly come and present a memento to our next speaker. The floor is all yours.
Very good afternoon to the esteemed members present here. And first of all, I would like to thank SIRC for giving me this opportunity to present a topic which has its own relevance in every point of time in terms of our practice. It cannot be a topic where it is like one time it gets a peak and one time it gets sometimes it goes down. It is not like that. So every time this particular topic has its own relevance, both in terms of practice as well as in terms of litigation as well, right? And I know this is a very tricky time of the day, that is especially after lunch, to deliver a session on a topic which predominantly the members here are mostly aware of. And I know that the members are expecting something which can add up to their existing knowledge and existing understanding of the topic which they already have. So I would like to try my best to give the best of add-on efforts or add-on knowledge for you, and let me also try to make it interesting as well for you to not having your post-afternoon nap, right? Okay. So this is a very important time of our era, where we have witnessed a greater change in terms of the Income Tax Act. When I say the word change, I put it in double quotes. So there are changes in the recently introduced Income Tax Act of 2025, but predominantly the changes can be found in terms of its numbering, in terms of its drafting, in terms of its presentation as such, except few topics where they have tried to give some change, but otherwise it is like, if I can able to say this, old wine in a new bottle. This is not something which I am saying it now. This is like Income Tax Series-7, right? This is, so there are so many other faculties who would have, or faculties or presenters who would have come before me and said the same thing, and I might be repeating them, but otherwise we all have to have this understanding, especially on this topic, residential status, where you can see, you can make a parallel reading of the BAR Act, the provisions of the BAR Act. You can find many words and many narrations of the provisions are done in the same way how it had been in the erstwhile law. So in 2025 Act, you can see you can maybe unlearn the subsections which was there in the earlier law and understand the subsections in a revised manner, not even the original section, because the original section, section 6, retained in Income Tax Act 2025 as well. So section 6, residential status in the 1961 Act is being retained in 2025 Act also, and the clauses, explanations, subclauses had been renumbered in terms of subsections. That is what, and they have kept certain vacancies for explanations and provisos to be inserted in future, maybe. Because this particular section, I have a doubt whether they would want to introduce more of provisos under this law, because this section is almost like matured. They have made it more comprehensive. But we know in our country, we try to find, as a professionals, we have, we understand the law more than the actual legislators. We understand where there are gaps, where there are holes as such, and we try to advise accordingly to our clients. So the every act, every provisions will have its own changes as well. So the same thing can be applicable for this section as well. Without making any further delay, let me just take you all through just like a brush up of the provisions available. So these basic stuffs, we all know that we have to categorize the residential status of every person, like resident, non-resident, resident, not ordinarily resident. We all know that based on the residential status, the income also will be assessed under the income tax law. So if a person is a resident, then they come under the complete bracket of the income tax law. Wherever you get any money, any amount on credit, you are going to be assessed under the income tax law. It is like a CCTV kept in an open ground where you cannot find much of a blind spot. You have to be under the surveillance of the income tax department as far as you are a resident, we all know. And if you are a but not ordinarily resident, you know there are certain exceptions, and non-resident, you will have to give only whatever is connected to India, income earned or accrued, arise, all that stuffs we have in section 9, which is very detailed. I'm not getting into those sections now. I am just trying to stick on to this section 6 only. And the determination of this residential status, we know, is not a unique stuff or unique thing for an income tax law. It is also there in certain other laws as well, like FEMA Act. There also the residential status will be determined, and certain other areas as well. If you take double tax avoidance agreements, specifically the residential status would be defined even in that DTAS as well. So the residential status are there in many laws and many regulations, and most laws, especially like a major enactment like income tax law, which I would consider like a FEMA Act. So that also has follows similar provisions of Income Tax Act in terms of residential status. I mean in the duration of stay. I meant about the duration of stay. Just a quick snapshot of the provisions, a quick comparison between the erstwhile law. I won't say existing, it is the erstwhile law under section 6, how the section 6 provisions are designed, structured, and how it has been transformed into the new act, 2025 Act, how the subsections are structured. You can find the narration, the flow of narration is also similar. It is retained its own original character even in section 2025, in the 2025 Act, right? So section 1 has come in the same way. Section 1A has took its place at the appropriate place in the same direction in the 2025 Act as well. Similarly, section 2, 3, 4, 5, 6, you had 6 subsections in old 1961 Act, and now we have 14 subsections in 2025 Act. Does it enlarge its applicability? Does it enlarge its scope? Whether the residential status characteristics had got enlarged because of the subsection numbers from subsection 6 to subsection 14. Is it enlarged? No. As I have mentioned already, the provisos, the explanation 1, explanation 2, and all had got its place as subsections under the new law. Earlier what you called as explanation is now come under the category of subsections under the new act. That is the major change you can call as far as the section 6 is concerned. Just to understand the flow, you know that the basic change they have made is calling the previous year as a tax year in terms of section 25 Act. Similar wordings are available across the section 6 as well. Everywhere, wherever there was previous year, now it has been replaced with tax year. So we can we can make a assumption ourselves that the tax year is more understandable and more it is explanatory in nature than the previous year. That is what we can able to slightly understand now. So coming to the first section of section 6 earlier law, which is subsection 1, which directly talks about the residential status for a individual. So that section 1 is now, subsection 1 is now in under subsection 2, right? Subsection 1 talks about opening paragraph, which was not having any subsection reference in the earlier law, is now being put up with a subsection number. It's like a numbering, the change in the drafting. They have made a numbering, like, in our offices and all, what I used to do, like, we have our article. Sometimes, to our surprise, article person may give a good quality deliverable. A report would be a good report where you may not find much of a changes or difference, right? And that is being given to you for review. What we will do? If you just go through, you can see predominantly the report is looking good. You don't see much of flaws in terms of the concept or whatever they have wanted to convey. What we will do, sir? Yeah. So what we do is, like, one paragraph would be written in 5 lines. We would feel that, okay, this paragraph looks little bigger for the client to understand. Let me break it into 2 paragraphs. So from the full stop, I will make the continued para, we will take it to the next line. We have all done that, sir. Anyone here have not done that at your office? Not done? Right, I know. So maybe I should have asked anyone done, so that you could have raised your hand or something, so that afternoon session can become more energetic by doing some exercise. Yeah. Yes. So we make that cosmetic changes. We will say that, okay, you have put a bullet point here, make it like a sub numbering, 1.1, 1.2, something like that. So those cosmetical changes we will make. Similar to that is especially done in this particular section 6 of Income Tax Act, right? Okay. So 1A, 1B was the clause B was removed earlier. Now that requirement is not there in the new law, so they have made it as A and B. C had become B, that's all. And when it comes to the employment, the crew, person, member of a crew of a ship, all that had now been brought into the sections here. So you can see that explanation 1A would have 2 limbs in the earlier law, which will have and one. The first limb will talk about the crew member, a member of a crew, and the second limb will talk about the person who is has taken up employment. So that had been now brought into 2 separate clauses, right? So subsection 3 has 2 clauses. Then a citizen or a person of Indian origin. So relating to that, you have a second explanation that has now been brought into a different subsection, section 6.4 A, B, as well as it is now taken to section 6.5 as well. Section 6.4 and section 6.5 talks about a citizen or a person of Indian origin relating to them. So a citizen, we will discuss, we will discuss that the provisions in the next slides. Subsection 5 especially talks about the citizen or an Indian origin who has income exceeding 15 lakh rupees. So for them also they have been clubbed or merged in the same explanation earlier. That was not good. The legislator were not finding it good. They wanted to present it better, so they brought it as a new subsection. And deemed residency, that was relatively a newer provision. Okay, in 2020 Act, if I am not wrong, the 1A subsection was inserted, a deemed residency subsection was inserted, that has just carried forwarded in the new law as well. And in terms of HUF firm, BOI, which was earlier subsection 2, has now brought to subsection 9, and company 3 had become 10, and R&OR subsection 6 had now come to subsection 13. And there was an explanation under subsection 6 that has now taken it as subsection 14. So that is how the newer, the new law is structured in terms of its section, but section 6 retained its own character. So here on we will all try to refer, or I will only refer the section 2025 Act, The sections which is referred here are only Section 2025 Act. We may also have to just correspond with the earlier law because we have got used to it much. It has now got into our blood and nerves. So now we have to just try to correspond. Anyway, we'll try to learn the new sections as well. We know that there are two conditions, which is 182 days presence in India, and the second clause says that 60 days the person has to be present in India, plus additionally, because it uses the word and, additionally the person also has to be there in India for a cumulative period of 365 days in the preceding 4 years. So in the earlier law they used to have previous year. So what will I say for that earlier years? They say that preceding to previous years. That is what the words they have used in the earlier law, preceding to previous year. Now it has become more easier for the lawmakers to word it, preceding to tax year. So that is what they are using it here. Otherwise, it is all the same provisions. And in the earlier law, I am just talking directly on the Bare Act provision. The wordings, how the wordings are now, it has found its change. Earlier they have mentioned like 365 days in collectively on all the 4 years put together. The word was denoted as amounting in all. That was the word it was actually mentioned in the law. That has now got into a more clarified version, which is cumulatively. So cumulatively on all the 4 years, the person's stay in India has to be exceeding 365 days in addition to 60 days in the tax year, right? So that is being retained here. There is one important case study I just wanted to bring in here, which is directly relating to this particular provision. Relatively a newer case study. Mitesh Vijay Gulati versus ITO, which is a Income Tax Appellate Tribunal Mumbai case. If there is any member who is already aware of this case, you can just join with me, or anyone who is already aware of this case. Okay, let me just narrate the story, this case as a story here for your remembrance. So in this particular case, the assessee had worked outside India. He is working outside India, and the person had the person had come to India, right? So what has happened? The person had stayed in India in the previous year for 210 days. The person had stayed in India in the previous year. That time it was previous year. So in the previous year, 210 days, and the year before, the person had stayed is more than 365 days. We will have that understanding as well. Now, when you determine the residency status, I have not given little more. There are little more details to it. Let us just go one by one. By having this understanding, this facts, what will we consider this person as? Resident. See, actually, this particular case has implication in two subsections. I have just put in it here because in that subsection I have another case law to discuss. So I just brought this case law here. It also has one more provision where the person who had taken employment in the previous year, how the number of days, what will be the number of days of stay required in the previous year, that is there, that is there in another subsection. So that is also being included in this case law. So what has happened here? 210 days the person was there in the last year. So we will understand it as a resident. But there is one fact to be understood. In that 210 days, we need to dissect that. So in fact, the person had not come, the person had left. Sorry, I just wanted to correct this. The person left India in the previous year, and before leaving, the person was there for 210 days in India. So if the person had left India for employment, we all know that the second clause B presently, the word 60 days has to be replaced with the word, how many days? 182 days. If the person had left for employment purposes to outside India from India, it will not be 60 days, it will be 182 days. So earlier law was given, the provisions was designed in such a way that 60 days has to be replaced with 182 days. This is what the wordings which was there in the law. Now what they have told, they have made it more simpler. Clause B will not be applicable for that person. Very simple. They said clause B will not be applicable. That means only clause A will be applicable. Clause A says that the person has to be there in India for 182 days. Understood? Now, so the person is there outside India. In that case, 181 days he was outside India for employment purposes. This person left India for employment purposes, and 181 day he was in India when you take the employment outside, right? 181 days. But the provision says that 182 days. But I said 210 days. What happened? There was another travel he had made. First he went to US for looking for some employment. 30 days he spent there. Around 29 days he had spent at US trying for employment. Did not find any employment. Came back. Then he got an employment with Singapore entity. He left India, and that time period was 181 days. That means the stay in India was 181 days. So if the person had stayed in India for 182, then this he becomes a resident, right? If the person had not stayed for 182 days, he becomes the non-resident. Understood? That is what the provision says, right? So here the court, the question before the court is whether the entire 210 days has to be seen here or only 181 days has to be seen, because for employment purposes the person was outside for 181 days, but overall he was outside for 210 days. Now whether we will consider the other provisions and consider the employment purposes, or we will follow this clause, earlier clause C, now clause B, 60 days. What we have to follow here, that was the question before the court, and the court has told here that the person was in US for employment purposes. There are other case laws in that particular judgment the honorable members have referred to. In those case laws, they have mentioned there is one another landmark case which I will take it up in the next subsection. In that case law, they have clearly mentioned that it is not only required that you have to be in the active employment for applying this additional threshold, the 60 days becoming 182 days. It need not be an active employment. Even if you go for searching for employment outside India, you can cover that in this 182 days category. So accordingly, the person was not in India for 182 days in the previous year, because including the US visit where he had gone for searching for employment purposes will have to be included as left for employment, and the person is treated as a non-resident. Accordingly, what happened? The salary the person had earned from Singapore will not be taxed in India. We all know about section 9 and all, where the income accrue or arise in India as well. So since this person being a non-resident, this salary which was brought into tax by the assessment officer had been removed because of the residential status. Are we clear with this tax law? Right. So next is that is what we have just discussed. A person who is part of the crew, shipping crew member, or he had left for employment purposes. So the 60-day rule does not apply. So here in the new law, the wordings are it does not apply. It is not saying that 60 days has to be replaced with 182 days. That is not the wording here. So we will be sticking to the drafting of the new law itself. So I am just brought into some issues for easier reference here. Sorry. Okay. Mr. Z, Indian citizen, signs off at Rotterdam and signs on to another vessel. Signs off. The person had been a part of a crew, been a crew member of a ship, he had signed off from a vessel and the person has signs on to another vessel that was outside India. So he had been in part of a crew member on one vessel outside India. He had shifted his contract and got into another vessel, became a part of another vessel. Here what has happened? Passport record shows that 184 days. This particular provision it was removed later as well in the older law. In the current law, it is there as a subsection itself. In the subsection itself, this particular provision is taking place. Just to bring in, I am just getting the discussing this particular issue. So what is the conflict here? As per the passport records, the stamping made in the passport, his stay in India was looking as 184 days. As per the law, we know that 182 days is the limit. Okay, crossing 182 days stay in India, he becomes the resident. Less than 182 days, it has to be. But the continuous discharge certificate, the member card of the particular crew member, the entry date and the exit date would be mentioned there. So accordingly, that person's record shows 179 days. So which record has to be followed in terms of determining the status? Passport 184, CDC says 179 days in India. So which record we should follow for determining the residency, whether the person is resident or non-resident? So in the subsection 3 itself, it says that we need to consider the continuous discharge certificate in terms of a crew member. The entry in passport is not relevant for that particular crew member. So continuous discharge certificate record is the primary record in terms of determining the period of stay in India. As per that record, it is 179 days only. So accordingly, earlier it was not there. Earlier law, I am not saying earlier in the sense, at least I am not exactly sure which was the date, but more than 10-15 years back, this particular provision was not there. Later, through a amendment, they have brought in an explanation in the old law. Now it has come under the section itself. Okay, that explanation is removed and brought into the section. So CDC records is there in the section itself, BAR Act. Okay, next one. Remote working. This could be more relevant for present day scenario. X leaves for a UAE job on September 15. That is, he had got employed by a UAE entity on September 15. But works remotely in India. Okay, before joining, he was working in India for until October 30, maybe for visa or other purposes. He was there until October 30 in India only. So what has happened? Stay 178 days. Indian income 22 lakhs. UAE, there is no personal tax. We will forget about the last part. Whether he is qualified for leaving for employment. That is the question. See, if you take the day he had signed up for employment, that was September 15. If you take September 15, he had left India, his stay in India would be less than 182 days. If you make a counting, that is what it will come. But if we consider the actual physical moving out from India that has happened on October 30, if you make a counting from there, he had stayed in India for more than 182 days. That is what the conflict here. So what do we have to consider, and as a professional, what we will try to advise here? If the person is a resident or a non-resident. Resident? Okay. You are right. He is a resident. Okay. How I have told in the earlier case law that the looking for an employment, going outside India for searching for an employment is effectively being employed, left for employment purposes only, because the law, the section uses left for employment purposes. So He had left for employment purposes, whether he has actively engaged in employment or not, whether he had earned salary or not, he left for employment purposes. So that way, that period was also being counted, included for the purpose of employment calculation, left India calculation. Here, even though he had been employed by a foreign company, he had been employed, signed an employment, maybe earned in the foreign currency, earned salary in foreign currency, but still the physical presence is there in India. So the day when he had physically left in India, that is the day we have to count for determining the residency status. So 178 days is the period of stay outside India. That means other side will be the stay in India, right? Okay, subsection 4, person of Indian origin, citizen. We all know a person who is a citizen of India or a person of Indian origin. Recent 2020 enactment brought into the older law is now carried in the new law as well. So this particular provision says the person can visit India if the person is a citizen of India or a Indian origin. So the word 60 days for the clause B, the word 60 days has to be replaced with 182 days, right? That is the relaxation given for Indian residents who visits India. And when this particular amendment was brought in the older act, we need to understand the reason why this amendment was brought in, why this relaxation was given for Indian citizens or a person of Indian origin. See, predominantly there are some 2 case laws here. I would discuss that case laws as well, but there is one understanding we should make when we refer this section. Predominantly, this section is applicable for a existing non-resident. This particular section is applicable for a existing non-resident, because the case law, the second case law which I am referring, is going to touch that issue as well, right? Existing non-resident. And who comes to India, that is what we call it as a visit. When you call a visit, let me just put you this way. Some relatives of you come to your home, okay, come to your home for a visit. What is the understanding, sir? It is temporary. That means the particular visitor or the relative has to leave someday. How many days, that depends, but the person has to leave back. So that is what we should understand it as a visit, because the section uses the word visit. If there is any relocation, okay, because there are various case laws under this subsection. In one of the case law, what happened, the person was employed outside India, 200 days he had spent in employment and came back to India. He stayed in India for like 165 days, etc. So he had claimed that he had visited India. So under this section, what is the period of stay he should be there in India? 182 days. But that person was there only for 165 days. But how that person has come? Why that person has come? Because his job was there, not there. He resigned from the job or he was expelled from the job, whatever the case may be. The person had came back permanently. So what that person claimed, for that particular year, he was having salary for the part of the year outside India. So that salary was brought into tax. It will be coming into the tax if the person is a resident in that particular year. Yes or no? That person stayed in India for 165 days. Whether that outside salary has to be brought into tax in India, that was the question. It has to be brought into India because the person had come on a permanent relocation. The person had come on a permanent relocation. We cannot consider that position as a visit. There is one very famous person, whose case law, which is 2026 judgment, 2026 this year January judgment. We will discuss that as well, falling under this particular issue. So coming to this, 60-day rule has to be followed. It will not be applicable if the person is coming on a visit. That means 182 days the person has to stay in India. Why this relaxation is given? I started earlier. So why this relaxation is given? Because if a person is a citizen or a person of Indian origin whose forefather were in India, they might be having a lot of properties in India. So the main intention of that person's visit to India is to manage the, there can be some businesses they want to just overlook, not even manage. They want to overlook, or they wanted to sell off some properties. They wanted to make some settlement among the families in terms of the property situated in India. In those cases, there could be a situation where the person would want to stay more, right? So that casual visit to India, if it is only 60 days, there are many cases. If you want to sell one immovable property, a bigger property you want to sell in India, we all know that it is going to take a bigger time to find a better buyer, to close the deal, make the registrations happening. There can take more time. So 60 days was very lesser. Later, 60 days was initially there. Later they have brought into separate relaxation given up to 150 days. 150 days later had become 182 days. All this had happened not in this law. As I told in the first beginning itself, nothing new had come in this new law. Whatever the changes I am talking about had come in the earlier law itself, is now carried forward. So 182 days is the current position. That person has to be there in India to be called as a resident. If it is lesser than that, non-resident. So when I call upon about visit, I will give you one situation here. So the person had come to India somewhere around, let me say 10th of October. 10th of October of a financial year. He had left India on 2nd of April. So effectively, if you see, he had gone back. What he was doing earlier, he had continued to do even after leaving India. But effectively, if you see, in the previous year, not 10th of April, October he had come. Up to 10th, from 10th of October till 31st of March, that is the financial year. How many days it would be? Will it be more than 82 days? It will be less than 82 days. We all know that suddenly the depreciation comes to our mind. 3rd October will change, no? The depreciation, 182 days, 80 days income tax. So lesser than that. He had stayed in India for less than 182 days. Overall, he had left on 2nd or 3rd April. Even if you count that April as well, his stay was lesser than 182 days. Now, but what has happened, when we say visit, the coming, arrival as well as departure has to happen. Yes or no? So the person arrived in one financial year, departed in another financial year. Do we have to see it together cumulatively, or do we have to see it separately, these two financial years? Okay. When I say separately, visit has to have one arrival, one departure. That person arrived in the financial year. Whether the person departed in the financial year? No. Can we call that as a visit? I hope you understand my question. I am making the question clear. Can we call that as a visit because that person had not left back? He had not departed from India. He had stayed in India and it has not even crossed that 182 days. But it has crossed how many days? The original provision, 60 days, general provision, 60 days. Do we have to consider that person resident, non-resident, sir? That person is non-resident only, sir. That person is non-resident only because the intention of visiting India is what courts are looking here. So, in my another case, which I was referring little before, the person was there for some 80 days in India. Because he was working outside India, came back to India, left job, came back to India. Let us assume on 1st of January, okay, he had come to India. How many days he had stayed in India? 92 days around. It is more than 60 days, but less than 182 days. Here can we call that person as resident or non-resident? In the two examples I have given, sir, there is no much difference in terms of the stay. Okay, in the earlier example, his stay was less than 182 days, not departed in the same financial year. At the financial year end, he was there in India only, but not exceeding 182 days. In my second example, also he had not exceeded 182 days, stayed in India as at the end of the financial year, one arrival only he had marked in his passport. Whether these two situations has to be seen same or we have to differentiate these two situations. We need to differentiate these two situations. That is what the court is also doing it here. The court specifically looks for the objective of your visit. Because why the court is coming to that conclusion? They are looking at the explanatory memorandum when this provision was newly brought in under the law. They saw the explanatory memorandum. The explanatory memorandum says why this relaxation is being given. Because the person visits India for maintaining their personal properties with an intention to go back. That is what the explanatory memorandum says. Going by that, not with the law, not with the provisions of the law. They go with the explanatory memorandum of bringing this provision, coming up with this conclusion in their decisions. Right? So that is what we need to understand here. So the two case laws referred here, one is Abdul Razak, which is very famous or prominent case law in terms of residential status. What has happened in this Abdul Razak case is what I have mentioned as well. But sorry, in this Abdul Razak case, what has happened? This Abdul Razak is a business person in India. Okay, he was doing business. In the part of the year, he left outside India. He left to outside India, maybe somewhere around July time. He left to UK. For what purpose he left is that he wants to do business at UK. He wants to start some business at UK and do business at UK. He left India. What is the period of stay in India? Is it exceeding 60 days? And we assume that, or we know that in the earlier days, earlier years, his stay is definitely exceeding 365 days. So coming to this clause B, what does the clause B say? Earlier year 60 days, previous 4 years 365 days. Whether that provision satisfies in this case? Yes, because the person left somewhere July, August. Okay, definitely his stay in India for the past year, the tax year, was greater than 60 days. Condition satisfied. Whether the person is resident? No. That is one side. Second side of the problem. The person left outside India not for employment purposes but for self-business purposes. Can that person claim the exemption of stay in India for 182 days, the enhanced limit of stay from 60 days to 182 days? Can that person claim this benefit and say, I was not there in India for 182 days in the last year, so I become a non-resident? That is the question in this particular Abdul Razak case. So now, sir, what is that we can decide here? We will discuss about the court's decision. As professionals, what we can decide here? Yes, sir? Not? Okay. So he had not gone out for employment purposes. So that relaxation cannot be applied in this case. If that relaxation is not applied, what will happen? He will be called as a resident because his stay was more than 60 days in the tax year. Is that the decision we will take, sir? Or anyone has different opinion? Yes? Okay.
Business by myself is like being self-employed for this intention purpose.
So you are having a different opinion here. That means the person had left outside India for self-employment purposes. So self-employment, the word employment can be fixed in this objective. So it satisfies that eligible limit to give that relaxation. That is what is your opinion. Anyone is concurring with her opinion? You are also, ma'am? Yeah. And then can I take it like the majority of the members are against this assessee? That means if this assessee comes to your office as a client, you will say that you are a resident man, come and pay taxes for the income you have earned during your self-employment at UK. Because if he is a resident, what will happen? That is what will happen. So that is what the advice he will give, sir. Okay. Okay, sir. That's what, sir. That is what majority I would take. Like, he is not for employment purpose. So we all have this understanding that if there is an employment, there has to be an employer-employee. Employer-employee relationship is there, then only I will call it as an employment. If it is a self-employed, who is the employer? So we are all, if there are practitioners here, so we being a practitioner, we call ourselves as a self-employed. So we don't have any employer. I don't have to report to anyone. Okay, I don't have to abide by any rules. I will create my rules. Right. Okay, so coming to this particular judgment, the court had taken that ma'am's view. So may I get your name, ma'am? Sudha, ma'am. So the court had taken Sudha ma'am's view in the especially Kerala High Court. Kerala High Court had taken Sudha ma'am's view and said that you cannot see the employment purposes in a literary manner. Literary meaning, you cannot give a literal meaning to that. You should see what is the objective behind that provision, to earn money, to do some activity connecting to your work. That is what it has to be seen. The court had given a wider view for that employment purposes, so that covers self-employed as well. So that is what the court had decided. That's why I told you it is something which has gone outside our general understanding, common understanding of us. Those decisions only will call it as prominent decisions or a landmark decision, something like that. So that is what I just mentioned. Yes, sir. Yes, sir. No, it had not gone. Yes, and because the decision which I mentioned, the earlier decision, Mitesh, that decision had followed this particular decision there. The court had quoted, the tribunal had quoted this decision for giving the 30 days I told you, when the person had visited US for looking for employment. They said this particular court, the court had in the judgment, I will tell you, especially to have detailed understanding, the court says that a self-employed, has to be understood for earning and for the livelihood, the work. It could be the work. It need not be give a literal meaning of having an employer-employee relationship. That is what they have followed. So there is no further appeal on this particular case as well. So that is the current position as far as decision is concerned. So second one in this Avatar Singh Vadwan. So here this person is a seafarer. So this person was actually this case law does not much fit in this particular provision. It more fits into the section 9 related provisions, but it has a reference to this particular section. That's why I have brought in this case law. But what does the case law? I will just give it in very simple words. This seafarer was earning income while being on sea. 337 days he was working in vessel. That vessel was a Indian vessel. Indian ship he was in, but the vessel was there in international waters. So his stay was in international waters for 337 days. And after he had come to India, from there he had been dropped back to India. Here the residency status, what has happened, where that residency conflict comes. So by looking at the basic fact of this, what is that we will understand, sir? What is the decision we will take with this basic fact of this person not in the land of India? He had been on a vessel. That vessel was also put in some international boundaries, international waters for almost 337 days of the year. So by knowing this fact, what is that understanding we will come to? Whether the person will be treated as a resident or a non-resident. That ma'am had immediately thought, okay, if I am asking this question, definitely our general understanding should not apply here.
Even though he's in international waters,
If he is on the ship, that means he is in India. Oh, okay. So Indian company had employed this person. So he is under employment of Indian company on an Indian ship. That means he is in India. But it is not nowhere in the section I have referred, or you wouldn't have studied anywhere in the section. In the section, when you see that particular section, it says that a person, member of a crew, ship crew, who takes up employment and goes on a ship, then in that case also 182 days. That is what is mentioned. In that provision, they have nowhere mentioned that where the person has to be employed by a foreign shipping company or he has to be in the foreign ship. Nowhere it is mentioned. The section uses the word foreign going ship. Okay, what is foreign going ship? One of the, either the departure or the arrival place has to be outside India. That is what is the understanding in terms of foreign going ship. So that is what is referred. They have not mentioned Indian company, Indian ship. If he is employed, then he has to be a resident. No. For example, I will just put it a little further. That is not the facts of the case, but I will just try to slightly tweak it. That person was not there in the international waters. He had been employed by an Indian shipping company. He had taken up the sailing. He had gone to some destination. On the destination, within relating to ship, he was working somewhere, but on the land, on some country. But in the harbor only. Let us assume that he had not even left the harbor area of that particular country. Now will you change your position, ma'am? Or will this still the same? Okay, ma'am, but I already discussed that passport entry is not relevant for a shipping crew member. Only the CDC records. The CDC records will mention. If you go through the CDC records, it will mention that person had landed somewhere. The moment he had landed somewhere, he will have to make an entry there. How many days he was on land, how many days he was on the ship, all that entry will be there in the CDC. So, CDC records is the relevant record. But my question is whether the position will change or the position is still same, that the person is resident only. If you say that the person is resident, I would call that you are being more aggressive than an assessing officer. And I don't know, the clients will be scared because going against the client. Assessing officer does not much actually in the initial stages. That ITOs will go with all these assumptions, but commissioner level who had filed this particular case, CIT, they have not contested on the residential status, that they have agreed that the person is a non-resident. Because he is part of a shipping crew member, he was not there in India for 182 days. So he is a non-resident only. They have not contested that part. But initially that question was there because there is another act, Merchant Shipping Act, some act, I just not recollecting the name. So in that act, it says that if you are contracted by an Indian shipping company and staying on an Indian ship, you will be treated as staying in India. You will be effectively staying in India. That is what that particular act calls for. So based on that act, relying on that act, initially assessment officer had contested his residency position. But later within the department, they have agreed that the person is a non-resident. That's why I brought in this particular case here. The bigger part of the case lies on the section 9 related provisions. Okay, if he is a resident, whether the income he has earned, non-resident, that position was made there. There were like section 68, section 9, there are so many other provisions relevant. That is all the case law goes. But this is the one part of the case which is answering this question. Okay, now coming to this particular situation. Mr. B, person of Indian origin from UK, stays for 145 days. By looking at this, we know that the person had not crossed 182 days. Person of Indian origin has to stay in India during the tax year for 182 days. But the person had been there only for 145 days. She negotiates business acquisitions, set up some office works and all that. Does a stay involving economic business routes still qualify as a visit? So sorry, it's a question. So what does that the position here says that the person had come to India. I told you when the law was introduced, the relaxation was introduced in the law. They have given an explanatory memorandum which says that this particular relaxation is primarily given only for visiting your family, okay, for some medical requirement of the person, okay, all that case. But this person is not doing that. That person is taking some business decisions during the visit, but the visit does not cross 182 days. So here the assessment officer contests that the visit is not being made here, but the person is not visiting here. The person had actually come for doing some business in India. So you cannot bring into that particular provision of 182 days. That you have to bring in under the clause B, the main provision of 60 days only. So that person had crossed 60 days. So you need to bring that person under resident category. That is what the contention here. This was given in AAR rule. It is AR ruling. Smita Anand. See, a visit, the principle they have brought in here is a visit presupposes a temporary stay as well as with an intention to return back. So what you do that was given in the explanatory memorandum was just to make you understand about why this law was brought in. It was not a stricter guideline that you need to come only for these purposes only. It was not given there. But the reason for bringing in this relaxation is what only given there. So you cannot call that or bring in that here and make it. In fact, it is not even a contention. It is an issue which was taken to the AAR. We all know that the person can take a prior judgment for their position. So AAR only. But if it is a return after the cessation of employment, the person was employed or doing some business or whatsoever at outside India, came to India, did some business related activity, took some decisions, etc., had a temporary stay of 145 days, left back, continued the work there outside India, what the person was doing earlier. So that case will come under the visit category only, even though the person had taken certain business decisions in India. But if the person had left the employment or something, came to India with a permanent relocation, because there is one another case law which I have not brought in. So for came in, but what happened around 80 days, 90 days he had stayed and he had even gone to another employment outside India. There is one another case I am telling you. Slightly modification of what is there in the issue. In this issue you understood, right? Irrespective of the much of the purpose, we will not go that much into detail. We will understand the person had made an temporary visit with an intention to go back. That is what the primary principle we need to follow. But what I am trying to ask here is the person was employed outside India, who had been in employment continuously 3-4 years, example, came to India, came to India because he had lost job there. He didn't know what to do there. He wants to come back to his place, looking for job across the globe, not even specifically in any country. Even in India, if he gets a job, he will join. So that is the intention the person had come to India. 60-70 days he was just looking around, or 80-90 days, more than 60 days he was there. He took up a job and went outside India again in some other country. So in this case, whether the person has to be bringing under that 182 days category, or whether the person has to follow that visit, or whether the person has to follow that taking up employment 182 days there, because he has taken a new employment as well in the previous year. Understood or not? That person had come on a visit as well. That person had left a job and came back. So all these conditions is matching in this particular case. So what will we decide here? The person has to be resident because more than 60 days, or the person had taken up an employment His stay is not more than 182 days in India. So he has to be treated as a non-resident. Which position we will take? But by calling this in this particular section, whether the person is making a visit, can we call this period which the person had stayed in India, can we bring it under the bracket visit? He had effectively made a temporary stay only. I am not denying that fact. But my question is, can we call that stay which has actually happened in India for a temporary period, for ease of understanding 100 days in India, can we call that as a visit to India? It has to be treated as visit. That means the citizenship or the PIO for whom that relaxation of 182 days given, whether that has to be applied here. But that person, for example, had not got the second job. He would have stayed back in India, yes or no? He would have become resident at that point in time, but now he is not resident. But I just doubt this particular position. I am not quoting any case law here. This is not any court decision. I am just giving on my view, my opinion on this particular, going through all these provisions. See, this particular judgment says that the visit has to presuppose a temporary stay. When the person initially came to India by leaving job there, whether that visit to India was temporary, does it have an intention for a temporary period? I told you intention is important because that is what the court is also looking at. Actual stay is required, and when especially for this visit case, intention is required. That's why I told you, that's why I told you, if he had got job in India, he was ready to stay back in India. So if it is an intention for a temporary stay, that means he should be looking only for job outside India. In fact, that itself court will not accept. I am telling you, because you get a job, you don't get a job, we do not know that. That's more of hypothetical situation. We do not know. But when he came initially, that cannot be brought under the visit category. That is number one. Number two, he had taken up a fresh employment in the last year, right? If you had taken up a fresh employment in the last year, your stay in India has to be more than 182 days, yes or no? So here, this person had taken up the job, fresh job, forget about the earlier job, fresh job he has taken up, right? And whether 182 days he had been in India? No. Can we bring it under that bracket and say he is a non-resident? Yes? Okay, fine. So I will just give you this particular position. See, that's why I am telling you, in this particular position, I have not came across any decision. There could be decisions. I have not gone to that much of a research. But in my opinion, that can be called upon. We can call that person's stay is less than 182 days because he had taken up the employment. Because this particular case law has a slighter reference, exactly not the same fact, but slighter this particular, what I am telling you, what you have also told is also slightly followed in this particular case law. I will just explain this case law, then you will understand this. So this Manoj Kumar Reddy case, what happened? This person was employed by an Indian company. Even your earlier question, Indian company, not a shipping company. He was not into any shipping, into some software. So Indian company had employed him. He had gone out of India, being an employee of India on a deputation. Okay, especially the deputation letter from the company specifically mentions that it is for a temporary period of 1 year or till the project completes. 1 year or till the project completes. It's not mentioned like whichever is earlier, all that cases. They have just made it as a plain reading. They estimated the project will take 1 year time. So they mention it is 1 year period until the project gets completed. That is what the deputation letter says. So what has happened, that person had left India on earlier to the tax year, not the question, the case, earlier to tax year. He had come to India after the completion during the tax year. See, he had not left India during the tax year. He had left India prior to the tax year. Okay, his project had taken more time, not even 1 year, it had taken little more than that. So he was a non-resident for the previous year to the tax year. He was a non-resident to the previous year to tax year because his stay was less than 180 days in the previous year of the tax year. But the year under question, that is the year when he returned back. That is the year when he returned back. So what happened? When he returned back, there was two situations. He returned somewhere around, let me say, I think October something like that, and he was in India. He came to India after the completion of the project, October, November, something like that. After that, he was in India. Whether that crosses 182 days? Whether that crosses 182 days? No. What has happened in between? He had come for a visit. Yes, sir. No, his income, salary was paid from their company outside India. Deputation, but the salary was paid outside India. Their subsidiary or some company. That is possible, no, sir. They may have some basic salary or stuff for the payroll being run, they will have it in India. But in some cases, they take salary from outside India when they are on secondment or deputations, etc. Yeah, per diems generally will be paid. That's more on a business visit, it will be per diems. Deputations, it is not like, maybe not like Indian companies project, it may be abroad companies project. Those things are not detailed in the facts of the case, of the decision. But what I am trying to say, that is again, not a question of residency. So my question is whether this person is resident or not. For that person had come to India on October, November. If he has come to on October and November, his period of stay in India is less than 182 days. In middle, he had come for a visit, then went back and then came back. So totally, collectively, including the visit, if you count, his stay was more than 182 days in India. Okay, but when he came back entirely in the later part of the calendar year, from there, if you count, it is not crossing 182 days, etc. Right? Understood? So what is the issue here? Whether we need to take collectively, because the department had taken it collectively and said that it is more than 182 days. So you need to treat the person as a resident. But the assessees, the AR had represented that first it was a visit. For visit it is 180 days separately. For second, you need to separately see that. Okay, that is how they have represented. So the court was also agreeing to the assessee's view. They have favored in favor of the assessee. So the first trip it was excluded. It is because that intention was a temporary. So for calculating the days, it was excluded. So in fact, it was not even, the return was not even, now only I am recollecting, not even December. I will just tell you that second, little later. The return is very interesting. But first period I will tell you, it was a visit. This fact remains the same. Collectively, it is greater than 182 days. That is there. But in initial travel was a visit. Later travel, he came back. That was on 31st January. 31st January or 1st of February morning 4:30 his flight landed. That was the time the person had returned back entirely. Now if you calculate from there, that was in 20 somewhere. So if you calculate the period of stay including the day he had arrived, if you can consider that 4:10 in the morning including the day he had arrived, it is 60 days, exactly 60 days. So the law says that 60 days or more. So include even 60 days It is accepted. So first part visit, the court agreed that that was a visit, 182 days is required there. And the second part here, had it been more than 60 days, court would have said yes, he is a resident. Because the second time when he came back, it was not a visit, it was a permanent return back. So 60 days if it is exceeding, obviously he will be a resident only. But here the beauty of this particular case law is that 60 days if you include the date of arrival. If you exclude the date of arrival, it is 59 days. So the AR, the first part we understood, that court allowed also, it is a visit. Second part, the AR is representing that you cannot include the date of arrival. Now my question to the members here, whether we have to include the date of arrival or not. We have to include. What, sir? No time we are we are supporting our assessee. We are always supporting our department. Assessee is claiming it is 59 days, sir. Department is claiming it is 60 days. Date of arrival is? Okay. Okay. I think it is the vice versa. I will also tell you, it is in the case law also they have mentioned. Here, how to answer this question, it is General Clauses Act. So they have referred to this General Clauses Act. When you calculate some interest rate, example, you need to calculate interest amount from a rate. How will we calculate? From this date to this date, the calculation start from that same day or it will be from the next day? For
Same day, last day is not counted. Right?
Interest calculation, sir. Sorry? No, it is the next day, sir. It is the next day. When you make any count, the first day will be excluded and the last day will be included. If that is the date, that date will be included. Okay, if the initial day, start date, it will be only from the next day. Okay, that is the general understanding, general clauses. So, referring to that provisions, the court said that the fraction of the day, which is not full day, it is the fraction of the day the person was there in India. We will not count that day. We will take the next day and see until the final day, that is 31st of March. For example, the last day for the financial year to determine this is 31st of March. If I go by your provision, it is like first day, 1st February is included, 31st March not included. It is also included. Here, maybe you may say that, sir, he had not departed, he had stayed for the entire day. But what I am trying to say here, even if he had departed, that day would have got included. That is what the judgment says, that the date of departure is included, the date of arrival is excluded, because the provision is intending to count the duration of stay in India and not the duration of stay in outside India. Because the provision says what? 182 days stay in India. So we need to calculate the days of stay in India and not the days of stay outside India. If I take your argument, like the date of departure will have to be included, the date of arrival should not be, that is what you are mentioning?
We said date of arrival will not be included. Date of departure.
That's what I was trying to say. So date of departure has to be included, date of arrival should not be included. That is what you are trying to say. If I go with this understanding, then I can calculate the days of stay outside India. But our intention is to find the dates of stay in India. So how many days the person was there in India? For that calculation, the date he had come to India is to be excluded. The next day only he is effectively in India for the whole day. From there, we will make a counting. For example, on 31st of March, end of the day he had left back to outside India also. Not a visit, maybe for some tourism purposes he had left outside India. Still he is resident only because that day will be included.
Basically, both these are not inclusive. Either you take this way or that way.
No, one day will be included, sir. It's not like both has to be excluded. Initial day has to be, when you start the counting, the first day has to be excluded. The day counting will start from the second day. That is the next day of the day of arrival. And until the, if it is a departure, it ends with departure, the day of departure will be included. Okay, they are not gone with fraction of the day and all here. That is not the concept. Right? Okay, they have discussed that as well in the judgment, but the decision was not given based on that fact. They have given based on the General Clauses Act, where the counting generally happens from the next, not from the day, the first one. Right, so that is what the case. There are two questions I mentioned. One is on the visit. They made 2 visits to India. One temporary, came and went back. Second, the project got over. Permanently the person had come in. So that period is only they wanted to take for this. In fact, here the department had came up with another thing, that since this 59-60 days is there, we will club that also with this. See, there it is 182 days. Here if I club, because that person had come back, so I can add that period also where he had visited. That period also I will include. It will be more than 60 days obviously. The court said no, that is not possible. That was a visit to be seen separately, and this has to be seen separately. If this was more than 60 days, then that person would have become resident. But here, this particular case, since that 1 day fraction just saved him from maybe lakhs of taxes. Can I proceed? So this is some circular that was during the COVID period, much not relevant. Maybe if there are any litigations you wanted to handle, you may have to handle, you can refer to this circulars. The circular actually has a detailed thing. I just wanted to give a reference of it here, like know how the calculation has to be made during the exact pandemic period, how the exclusions has to be given. Certain days, even though they have exceeded their stay, if that is falling under certain dates, then you can exclude it from your period of stay calculation as far as residency status is concerned. 2 circulars had come in. Sorry, 2026 case law. We all know about this person. Heard about Binny Bansal? Sachin Bansal? Yes, someone said. Flipkart, CEO of Flipkart. Earlier, previous CEO. Yeah, promoter and as well as CEO of when this particular case was happening that time. Happening in the sense relevant period. So this happened somewhere in 1920. The previous year, relevant previous year for this particular case law was 1920. What had happened in 1819? This Binny Bansal, I think that is the period when Walmart had taken over the major stake in Flipkart. So until then he was being the chairperson, chairman, the CEO and as well as the chairman of this particular company. In 1819, during that period, later part of that 1819 period, not exceeding 182 days, later part of 1819 period, he left this company entirely, the Flipkart. He had taken up employment with some Singapore-based company. He traveled to Singapore. He went to Singapore for employment, like CEO of some company had directly gone as a CEO of some company in Singapore in 1819. But our question year under question is not 1819. The year under question is 1920. So what has happened? 1819 January, December or January, if I am not wrong, exact date, let us forget, but December or January, definitely it will be. That is when he had taken up the employment. Until then he was in India, right? So for the year 1819, that is not the year under question, but I am just asking you, for the year 1819, whether this particular Binny Bansal was a resident or a non-resident. Yes, sir. Everyone? I told you he was in India, part of Flipkart, left Flipkart, taken up an employment in Singapore company, departed from India in early January or late December of that 1819 period. That is when he left for employment. So if you actually see what is the period of stay in India during that 1819, is it exceeding 180 days or less than 180 days? Sorry, sir? No, 60 days is also there, but my part is it is more than 180 days itself. Then only we will go for 60 days. If it is less than 180 days, then we will go for 60 days. Here he had been there for 1819 more than 180 days. For 1819 he was a resident. So there was no much question there. That is not the question here. In 1920, next year, what happened? He came to India. He was in employment. He came to India, not leaving the employment and all. He came to India on a visit. For what purposes? Major purposes that he was having some mini shares. So much of shares he was having. He wanted to dispose of all those shares and etc. So for that purposes he came to India. He had a stay of around 145 days, something like that in India, and left back again to Singapore for employment purposes. So what the department said is, you are a resident. You are a resident because your stay in the previous year, 1819, I told you he was a resident. There was no question at all. 1920, he was a department claims that he was a resident and taxed the foreign income also in India. He had contested that. My first initial response from you, whether he should be treated as a resident or a non-resident. Actually, I have answered this question little earlier during the start. Sorry? Yes, not? Yes, not on a visitor. Why, sir? He came to India, went back again. No. See, he had taken up employment in the previous years. Sir, I am now talking about 1920. His employment he had taken up in 1819. 1819 he had taken up employment and went around in January or something. That period his stay was more than 182 days, no question at all there. But during the previous year his stay was only 145 days, where he came, made some work for 145 days, left back. My question is for this year, whether he is a resident or a non-resident. Why I am having this question? Number one, issues involved here. Number one, whether his stay during 1920, forget about 1819, 1920, whether he stayed more than 182 days? No. Factually we can understand. No, sir. Not 1819, sir. 1920. I am again reiterating. 1920. Obviously he was not staying more than 180 days. Factually he was only there for 145 days. No dispute at all. 145 days he had been there. So that is not covered. Second, 60 days. Whether he had been there in more than 60 days in that particular 1920. Yes, he was there for more than 60 days. And in the earlier years he was being Indian CEO and all that. His stay was obviously more than 365 days. In fact, they have given some calculation, 1000 some days he was there in India during the 4 years. So obviously under clause B, he gets satisfied to that condition. He has to be called as a resident. Department took the same stand. Department said, you have crossed the 60 days here, come back. But what he said, I had come on a visit. You need to give the extended relaxation. I was not there for 182 days on my visit to India. Okay, I was there less than 182 days. So obviously, I should not be treated as a resident because I will have this exclusion. Now you understand the issues. These two are there. He had also quoted one another additional thing. He had been there for employment. He had gone outside for employment. Even under that clause. See, he is quoting these two clauses. Under these two clauses, I will fall under non-resident case. Because both clauses says my stay has to be greater than 182 days. Where if I am on a visit. Second, if I had taken up employment outside India. Understood or not, sir? So these two is in support of Binny Bansal. That is what, with that confidence, he had gone to the court, tribunal. So now tell me, sir, what would have been the decision? Okay. I mean, that Smita Anand case, I told you AAR had told exactly the purpose of visit is not relevant. She had taken some business decisions also. But they said the intention presupposes that there has to be a temporariness has to be there. Intention to leave back has to be there. That is what they have relied upon. Yes. So your argument may not go here. So can we call that person as a non-resident for 1920? Yes, sir. Oh, I have given the decision, but okay, sir. Forget about that. Maybe I have not hidden it. Okay, but in our understanding, sir, I will see. It is the ruling of ITAT. We should know on what basis. No, that also we need to understand. If the ruling had come, even the ITAT had ruled as a professional. If we are not agreeing to that basis was not agreeing, we will go for a litigation. Yes or no? It's not that one court had ruled. We will follow that. We may press the department, we may ask the department to follow the tribunal decision, but we will not follow that. Okay, sir, just let us come back to the discussion. So, these two, that is what he has taken in his support, but the department support, they say more than 60 days, you will not fall under these two categories. So, can we just make some exercises, sir? How many of you say that the person, this Binny Bansal, has to be treated as a non-resident for this 1920, sir? Okay, ma'am. Since it's a very recent ruling and a very prominent figure, so let us just spend some time and understand this decision. Maybe like 2 or 3 I can see treating him as a non-resident. How many of you say he has to be treated as a resident? Okay, ma'am. See, actually, I know I also take classes just as a joke. I also take classes. Similar responses I get from students as well, where many of them will not abstain from voting. Like the recent floor test of Tamil Nadu Assembly, abstained from voting. We don't have so-called that Stalins here. Yeah. Sir, actually, whoever has said, I can see the more number of hands treating him as a resident. This is not surprising me because this is what is happening from the beginning in all my case laws, whatever I have presented. All of you are being very much favorable to the department. Okay, so here, what has happened? Here the assessee's argument is very much weaker. Number one, I will tell you. The first support he had taken is, he had come on a visit. But that's very weaker. Why? Because, as I already told you, there are various cases it says that, earlier cases itself, it says that this particular visit will be applicable for a non-resident. Existing non-resident. It will not be, the residency status will not be determined based on, the initial residency status will not be determined based on this visit period, 182 days. If a non-resident comes to India, stays for more than 182 days, there can be a chance that a non-resident becoming resident. That is the limited application of this particular provision. Whether the non-resident can be called as, can be continuing his position as a non-resident, or he has to convert himself as a resident. That is the limited scope that particular provision has, which is not applicable for Binny Bansal's case, because 1819 he was a resident and he was not an existing non-resident, and 1920 he cannot take this relaxation limit of 180 days. First thing, denied. Second, employment. Yes or no, sir? Is he employed outside India? Yes. If he is employed outside India, taken up employment outside India, what is the period he has to be there in India to become resident? To be resident, 182 days his stay has to be. Here, the earlier year residency status is not connected. Let me put in this way. Directly I will just tell you this. In the first question, earlier residency status plays a role because he was a resident, he continues to be the resident. This visit does not apply to him at all because he was not a non-resident at all. But in the second question, his residency status independently can be determined if he has taken up employment. Okay, in the previous year, example, if Bansal was, forget about the earlier period, starting from April until August, he was there in India. September 1, he had taken up employment outside India, left to outside India. Will he be considered as a resident or a non-resident for that year? First September, he had left outside India for employment purposes. But from April, he had been in India, let us assume. He was not an earlier non-resident, he was a resident only. He is a non-resident because his stay was less than 182 days. If the person has employed outside India, 182 days has to be satisfied for the previous year standalone basis, independent basis. Understood or not? So here 145 days only, not exceeding 182 days. Can he be treated as a non-resident? If yes, but tribunal had denied, you already know the decision. Okay. What's your name, ma'am? Bhargavi. Okay, ma'am, Bhargavi. So that is what the implication of the provision, the word, every word of the provision. We all know, as a professional, we all know every word of the provision matters. That too, especially in terms of a litigation. When we go for a litigation, every word, every letter of the law, the provision, it matters to us, right? So it says that employment, taken up employment in the tax year. Taken up employment in the tax year. If he had already been employed, this position will not be applicable. This provision will not be applicable to that person. So it is one-time applicability where he had initially taken up his employment. For that year, deciding his residency status, you can put this provision inside. Understood or not? But in our case, whether he had taken up employment in 1920, no, he had taken up employment in the 1819 case. For determining the residency status of 1819, he might have referred to this provision. He can refer to this provision, but sadly that was not helping him that time because his stay was more than 182 days in that year. But for 1920, he cannot carry that provision because he was already employed. Are we clear, sir? So that is the basis. These two bases the tribunal had followed and gave this decision and denied the non-residency status claimed by the assessee and favored in favor of department. So this provision, if you are a citizen or a PIO, there is one smaller difference the department is now, the law is now bringing in, where the earlier 182 days has to be brought down to 120 days. That means citizen, person of Indian origin came to India on a previous year, in the previous year or in the tax year, came to India, stay for 140 days, stayed for 140 days, forgetting about this provision, that particular person will not be treated as a resident, he will continue as a non-resident. For applying this provision, you need to decide what is the income of that particular person. That income exceeds, not equal, exactly 15 lakhs, this provision does not apply. The provision says exceeds 15 lakhs. Then 180 days, 82 days has to be read as 120 days. Yes, sir. So here, if the person is having income of more than 15 lakhs, example, if the person is having, in this case, what is the, why Singapore PIO stays 128 days, including multiple entries. We know that cumulatively only, it is cumulatively. Indian income 19 lakhs. This is very, very important. The income need not be the global income. It has to be Indian income. The provision wording says that income other than foreign sources, income from foreign sources. It does not even use the word Indian income. For ease of reference, we are using the word Indian income here. But the literal reading of the section says that income exceeding 15 lakhs from sources other than foreign sources. That is what the provision says. So obviously his income in India itself is 19 lakhs, more than 15 lakhs, whether the person is resident or not. Earlier year 372 days, all that is there. The person is resident or not. He is a resident because he had exceeded 120 days. If his income exceeds 15 lakhs, 120 days. B returns permanently from UK on Jan 10, 2026. In India, stay was 124 days, including the visits and all. Indian income 17 lakhs. It is obviously because 120 days, he has crossed the 120 days itself. Had it been the case 90 days, let us change that slightly. Instead of 124 days, he had stayed in India for 90 days. Obviously, that is what just now we saw previously, Manoj Kumar Reddy case, where he had come permanently, that too on 10th of January. There is no this question of fractions and all, obviously crossing 60 days. So in that year, he had crossed the 60 days, but subject to the past 4 years status, whether he had crossed the 365 days or not. By looking at it, you can decide the residency status. So here, as I have mentioned in the rule 8, it says the entry has to be CDC. I told you the provision, it's not in the section, sorry, it is given in the rule 8 under income tax rules 2026. Okay, rule 8. Earlier it was 128 or something, previous rules. Now it is rule 8, which says period of computation of period of stay for a ship crew member. And 6.7, earlier 1A, is now under subsection 7, deemed residency. What is the deemed residency? Very simple to understand. If the person is having income because of his residence and domiciliary status not being taxed anywhere in the world, and if the income exceeds 15 lakh rupees, then he will be taxed in India, applicable for citizens only. Indian citizens only, not even PIOs. Indian citizens. PIOs for visit category ke PIOs included. Here it is Indian citizens. I am an Indian citizen, already became an NRI, but I am having my stay in multiple countries. Okay, everywhere I stay 30-40 days only. Nowhere I have get caught in that residency status in the world. So the income I earn is not getting taxed anywhere. On the citizenship basis, because of this deemed residency concept, it will be taxed in India. The person will be treated as a deemed resident in India. But again, he has to have an Indian income of 15 lakhs, exceeding 15 lakhs. Same concept applies for deemed residency also. So Indian income exceeding 15 lakhs, not taxed anywhere in the world because of the residency or domiciliary status in nature or so. That is, they have given some reasons. It is not exactly that reasons has to be, but for some reason it is not being taxed outside. Sorry, sir. Okay. Not taxed anywhere in the world. Yeah. Just pardon me, whether is there earlier section 10, whether is there any exemption towards that salary is there? I have not checked that provision. If it is not there only due to the residency status, then we will see. But if the person is stayed in India, being in India, the person receives salary from UNICEF or something, still you say that the salary is exempted? No, his salary is only UNICEF, but he is entirely stayed in India. Will it be taxed in India? No, Indian income. It says income from Indian sources. Yeah. So, what it primarily says is it is not referring to the stay at all. It is not considering your stay at all. You may be outside India, not even entered India for 1 day also, but you are holding the Indian citizenship and you are having some passive income or some investment income or any type of income from India exceeding 15 lakh rupees, then he will be treated as a resident with a fiction of this law and will be taxed as a resident at par with resident, with an exception that I will discuss little later. But at par he gets the residency status, he becomes the resident. But whether he is ROR, RNOR, we will discuss little later, right. So, a small change you can see in the drafting of law. In the earlier law, if you want to give any non-obstante clause, overriding effect, we will start with the word notwithstanding anything contained. That is what was the word. Now we all know in the new law, they are not using that notwithstanding anything contained. Whether that means, is there no non-obstante clause in the new law? It is still there, but they are using the word irrespective of. So the change of wording, but the status of the provisions remains the same. So UAE resident claimed 1A shouldn't apply because UAE has no income tax laws, right. So deemed residency targets stateless high income individuals, not bona fide workers in no tax regimes. Very simple. What is that we are trying to say here? See, because of the residency or domiciliary nature of that particular individual, his income is not taxed anywhere in the world. Only those incomes those individuals are being targeted by this particular 1A earlier. Now it is 7. Now it is subsection 7. But if the person is in a country where there is no personal income tax, that does not mean, but he is a resident of that country. Clearly, as per the laws of the country, he is a resident of the country. Then he is not being covered under the deemed residency status because of no income tax concept in that particular law. He is bona fide in that particular country, so he can claim the benefit of non-residency status in India. So we all know, I am not getting into that in detail, it slightly digresses. DTA, we have that tiebreaker. There are rules in the double tax avoidance agreements. If you hold a dual residency, then because of 4 categories, factors are available in DTAA in order to determine the tiebreaker, in which you will have to clearly called as a resident if you are holding 2 residencies. So these 4 has to be applied in sequence, one by one we will try to apply. If anything falls in, then that particular country he will become a resident. So that is a tiebreaker rule available in the DTA provisions. Long back it is there, still it is there. So this one case law, very very famous case law, Azadi Bachao Andolan, we would have heard it many times. So coming to section 6 and 9, HUF firms, AOP, BOI, the other persons, okay, I am just calling the other persons. Residency status determined based on the control and management. HUF claimed RNOR status. In fact, RNOR and all is slightly later, section 6, subsection 13 only we will come. But since many are connected, I am just bringing it here as well, HUF. Because Karta recently returned from abroad. See, the Karta or the manager, the section uses the word manager in terms of a HUF. If the manager's residency falls on the HUF residency also, that is the basic understanding. Karta can be manager also, they can be brought under the word manager as well. So that residency status will be carried for the HUF entity's residency status. So the person had recently returned. I am not getting into the days and etc. and all. If the person karta or the manager is a resident as per the other provisions, then he will be the HUF will be a resident. But in case of a firm, okay, it is only based on the control, where the decisions, where the management sits, where the decisions are being taken, similar to POEM concept, right? So for the companies, POEM concept generally applies. For firms also, they have a reference similar to POEM concept, not using the exact word, but they say control and management. Control and management. If the partners sitting in India, firm in operating outside India, entirely operating outside India, income, everything earned outside India, not even received in India, but still the firm will be treated as a resident because the management and control of the firm is in India. Okay, that's what the residency status applies here. For the companies, place of effective management has to be taken. So, POEM, we all know that itself is a separate topic altogether to discuss for even a whole day we can discuss. That's how the POEM topic is. It's very vast. But we are just trying to have a quick understanding as far as residency status is concerned. Where the POEM lies on, that's where the residency also will be there. But we need to have one basic understanding as far as the company is concerned. By default, an Indian company is an Indian resident. Okay, by default, the company's residency is in that country. But if the POEM is different, then the residency status changes accordingly. So there are certain situations for determining the POEM. Strategic decisions taken by promoters, subsidiaries effectively controlled by Indian parent and all that. Finance decisions, policies. If the brain exactly is outside India, but there are official records, the directors are in India. There are so many countries operating like that in India, where effective decisions will be taken through phones or something, emails or something. But for all record purposes, we have Indian directors, Indian leaders, Indian owners. Not even the person who actually takes the decision may not even hold one share in that particular company. So those situations are there. Many of us are reporting those entities as Indian resident entities. But effectively, if you follow the POEM status effectively, then it will not be coming under. But it will again lead to litigation. As I told you, I am not getting into much of this POEM provisions here. There is one case law, very, very prominent, De Beers Consolidated Mines. Central control and management, wherever the central control and management is there, that is where, that case law is where you can understand. If you just go through that case law, it's very detailed. That's why I am telling you. You can understand about how they determine how the control is made, how the management is made, on what basis they determine where the actual management takes place and all that. That is what the case law generally discusses upon. But the residency provisions, the income tax section 6 is being very clear. If you find this is where the POEM is, then that is where the residency also. Okay, that is what the limited scope which we are now discussing as far as this provision is concerned. Okay, now coming to this part, section 13, almost the final provision under this section, because subsection 14 is nothing. So, in this resident but not ordinarily resident status. So, first of all, in order to apply this section 13, just for reference I will tell you, the first person has to be a resident first. We all know that. The person has to satisfy that whether the person is more than 180 days in the previous year or 60 days plus 365 days in the earlier years. If satisfies any of that condition, he becomes a resident. That we understand. But once he becomes the resident, he automatically becomes an ordinary resident or a not ordinary resident. These two status we are going to determine, we all know. So the conditions we know, if the person last year, okay, the person was completely outside India. Okay, let us say that foreign national, not even visited India for tourism purposes also. Suddenly came to India last year, took some employment in India. then his period of stay exceeded 182 days. He had exceeded 182 days in the last year. He becomes a resident, yes, as per the original provision section 6.2, he become a resident. But will he become an ordinarily resident? That means, what will be the implication? We all know section 9 if you refer to 5 read with section 9 and all. I am talking about the older act. So what will happen? His foreign income also will become taxable in India if he is a resident and ordinarily resident. But will he become a resident and ordinary resident in my example? No, because he had been a non-resident, he had never visited India in the past. So he had been a non-resident for 10 out of 10 as previous years prior to tax year. Okay, 10 years prior to the tax year, at least 9 years he has to be a non-resident in order to claim the status RNOR. If he had been a non-resident, not in this example, maybe some other example, an Indian citizen also, tax year, he was in India for 190 days in the tax year. But prior to that, he was outside India, been a non-resident, maybe he had a visit and all that, but he was a non-resident effectively in 8 out of 10 years. 8 out of 10 years prior to the tax year, non-resident. Will he be a resident ROR, that is resident or ordinary resident, or resident not ordinary resident? ROR. 8 out of 10 years only he had been a non-resident, but the provision requires you to be a non-resident for 9 out of 10 years. So if you are a 9 out of 10 years non-resident, resident only, because the first condition you are satisfying, resident only, but not a ordinarily resident. Predominantly you had been a non-resident. So continuing to that, there is a second part of the section which says that in the 7 preceding years, these 2 sections refers to not the tax year, prior to the tax years. So one says 9 out of 10 years non-resident you have to be. Second provision says that in 7 years, out of that 7 years, your total stay in India should not exceed 729 days. It should be less than 729 days. If it exceeds 729 days, resident, ordinarily resident. Less than 729, for example, 710 days in the all 7 years prior to tax year, then the person is resident, not ordinarily resident. So very basic understanding. Yes, sir. Yeah. So I was just coming to the example. I was just checking whether I have put the example there or not. So I will come to one situation here. So the person was there in India in the prior 7 years, out of the prior 7 years, 740 days. But in all the 10 years prior to the tax year, he had been a non-resident. Am I being clear? Let me repeat. In the tax year, he had exceeded 182 days. That is the basic understanding we are going to have. I am not going to repeat, because in order to refer the section 13, he has to first satisfy the residency condition, primary residency condition. He had exceeded 182 days in the tax year. He is a resident. There is no doubt on that. But being a resident, you are ordinary resident or a not ordinarily resident. For the determination, I am giving you 2 situations. Number 1, in the past 10 years prior to tax year, all 10 years he had been a non-resident. That is 1. Second, his stay, if you calculate for 7 years prior to the tax year, his stay in India came to around 740 days. 740 days. Is he a resident, not ordinarily resident? Resident, ordinarily resident. Everyone, sir? Ordinary resident, one answer. Anyone says resident, not ordinary resident? R and over. How many of you, sir? R and over. Okay. It is resident. Sorry, okay. Before I answer to this question, let me first go to the original condition. Section 6.2. Presently, section 6.2. I was there for 80 days in the previous year. Prior to that, more than 365 days. 80 days, but not 182 days in the previous year. Not went out for employment and all that stuff. Will I be treated as a resident or a non-resident? I am again going back to the original question. Resident. But I have not satisfied 182 days. See, I was there less than 182 days, but more than 60 days, and prior to that I had been there more than 365 days. Will I be a resident or a non-resident in the previous year, the tax year? Resident. Here we are not looking that both conditions are to be satisfied, because the provision itself has the word or. The conjunction used between the two clauses is or. So either one, if it is satisfied, then you are a resident. You are a resident. I am talking about the original provision, the section 6, section 2. Okay. Here in this provision, what do you think the conjunction is used? And or or? I will first check whether it is given here. Oh, Kurtitana. Okay. Okay, here the word used is or again. That means whether both has to be satisfied or one has to be satisfied. Anyone. Okay. So in my example, coming to my example, where the person had been there in India for 740 days, will he be treated as R and over? One condition is satisfied. One condition not satisfied. Which condition satisfied? Sorry? Second one satisfied. Not satisfied. Second one not satisfied. First one satisfied. First one satisfied, second one not satisfied. Will I call that person R and over or R over? R and over. Here also it is R. Any one, if you are satisfying, then you are R and over. I mean, if you are satisfying both conditions, you are R and over. What is the condition we need to understand? Positive understanding, negative understanding we should have. We cannot convert everywhere a positive provision into a negative provision. Some places it will work, some places it will not work. Everywhere if we calculate the other side of it, our understanding may go wrong. Here the provision is says, you had to be a non-resident in 9 out of 10 years, number 1. Number 2, your stay has to be less than 729 days in 7 years. That means, if I had been there for 10 years as non-resident and stay is 710 days, example, both the conditions I am satisfying, I am R and over. There is no doubt in that. Both conditions I am satisfying. Then only I can call it as condition satisfied. 10 years or 9 years I had been a non-resident, 710 days my stay is there. So both conditions are satisfied. I am a R and over, obviously. I had been a non-resident for 9 out of 10 years, but my stay was 740 days. How many conditions I satisfied? One condition. Which condition I satisfied? First or second? First I satisfied, second I have not satisfied. Now whether I am R and over or R over? R and over only, because of the word R in between. So in order to treat as R over, resident and ordinarily resident, I need to dissatisfy both the conditions. Dissatisfy both the conditions, then only that I will be a R over. Yes sir, I don't think much is there. Some of it we have discussed in the earlier case laws and all that. So coming to the final slide. I'm just leaving it to you for your quick recap what we have just quickly discussed. So we have come to the conclusion of this session. I think I have taken a slightly longer duration in this session. I just hope that I have not bored many of you. Some of you I definitely cannot help myself. And being member, you should not feel at the end of the session that I have wasted your time, because I know everyone's time here is very precious being a professional. So I try to do that. Before I conclude formally this session, I just wanted to have a quick time. If you have any quick doubts or anything you wanted to just discuss or clarify something. Sorry, ma'am. Okay. As far as bank account maintained, non-resident cannot operate resident bank account. Okay. You have to mandatorily have a NRO, NRE account. Okay. Let me come to that. But that is not even related to income tax. It's a FEMA related regulation. Okay. Maybe you can just ask your question. If I know, I can answer. Okay. No, I understand, but what is the question? Whether they can operate, that is your question? If you take the FEMA, as far as I know, I can able to answer this, ma'am. If you take FEMA law, it does not prohibit a person operating the bank account, which he already has being a resident. For example, when I was a resident, I had opened some savings account in a bank. After I become a non-resident, I operate it. For example, I operated knowingly, unknowingly, some reason I have operated it. That does not amount to any violation under the FEMA. Okay, FEMA only gives a directory mechanism there, where once you become a non-resident, your account has to be converted into a non-resident account. So that is there. When you become non-resident from a resident. Let us go to the other side. I was a non-resident. I had a non-resident account, NRO or NRE account. I became a resident later. That too, that residency has to be seen from the FEMA residency, ma'am. Income tax residency status does not affect this position. It's a FEMA residency. You have a separate provision for FEMA residency. It's very simple, not like section 6. They have clearly mentioned about 180 days stay only. Period of stay only is covered. Nothing much. They have given relaxations and all that stuff. So once they become a resident as per FEMA, NRO, NRE account you can still continue to hold. You can continue to transact. You cannot add money in that. If at all money gets added, it will be from the foreign source, which you had already had when you were a non-resident. NRO account, you can have it, obviously you can operate it, but it is directly again to make it as a normal account. NRO account, you know, it is basically a normal citizen savings account only, does not have much difference except the tag it has NRO, non-resident. NRE has its, definitely it has its different features. For that, FEMA clearly mentions about if you had opened the NRE account being a non-resident, you can continue to hold that NRE account even after becoming a resident. That is under the FEMA. Yes, ma'am. Yeah. Anything, any other question, ma'am? Okay, thank you so much for your patient listening for this entire session. I hope that at least in the initial, as I mentioned, some value addition I have given to your existing knowledge on the topic. I know definitely this topic is not having a standalone implication in any assessee, but it definitely is going to be a primary, or it may become a primary question also when you determine a income, because you would have seen in many cases, even including that Binny Bansal's case, because of the residency status, his tax liability had shooted up somewhere. If you see the exact the case law, his income was somewhere around 1086 crores. That was the reported income brought in by the assessing officer, considering him as a resident. But considering him as a non-resident, he has returned income of 8 crores. You can see the magnitude of difference in terms of the value only by answering to this residential status question. 8 crores had become 1087 crores. So that is the impact even this particular provision has, a residence provision. So I hope I had given some knowledge on that. Thank you for the opportunity and thank you for your patient listening.
Thank you, CA Venkataraman. You can be rest assured you have added a lot of value to everybody's knowledge on residential status. And it never seemed like as if it was a after lunch session. So you've taken us a lot of pain and effort, and with explanations you have really sharpened our knowledge. Thank you.